Hey guys, this is Luciano and this is Build a Career in Forex Trading. Now, if you want to be successful as a Forex trader, you should ensure that you master fundamental analysis. I repeat, if you want to be successful as a Forex trader, you should ensure that you master fundamental analysis. The banks trade using fundamental analysis, institutional traders trade using fundamental analysis. So if you want to be successful, fundamental analysis is something that you should ensure that you master. Majority of Forex traders do not understand fundamental analysis. They do not understand how to interpret economic data, how to use this economic data to trade the market. They don't understand sentiment, they don't understand risk aversion, risk appetite, and these are key things that you should understand if you wish to be a successful Forex trader. When you take this course, you will learn how to make money trading the news like an institutional trader. You learn how to predict the GDP results using correlation. You learn how to predict the CPI results, the durable goods results, and you'll get a broad understanding of interest rates, inflation, and the central banks and how they affect the market. You'll also learn how to use the retail sales, the PPI, PMI, and other fundamental announcements to improve your trading. We also discuss sentiment, risk aversion, risk appetite, and how these can impact your trading. You'll also learn the 5 major US fundamentals that you should focus on. After taking this course, you'll get a deep understanding of economic indicators and how professional traders use them to make money. So if you're interested in making money trading Forex, take this course. Now, what is the spread? Now, the bid and ask spread is the difference between the price at which a dealer will buy a currency and the price at which the dealer will sell a currency. Okay, so in this example, the bid is 1.4502 and the ask is 1.4505. So in this example, we have a 3 pip spread. So the dealer is willing to buy the currency at 1.4502 and they are willing to sell the currency at 1.4505. Now, the only way to become successful as a trader is by properly educating yourself, and the fastest way to do this is by finding a successful mentor. Okay? Now, a mentor can teach you years of experience in a short period of time, which is why it's extremely beneficial for you to find a mentor. Now, I do provide mentorship service to serious trader via learnforexmentor.com. So if you're interested in mastering the Forex market, you can go to www.learnforexmentor.com and sign up for my mentorship program. I have a one-on-one mentorship program where I help you one-on-one via Skype. I teach you the ins and outs of the market, how to analyze the market, how to enter trades, how to exit trades. So when you sign up for my mentorship program, you will learn not only how to analyze the market and identify the direction of the market, but also to identify when the market will start moving in that direction. See, one of the main reasons why a lot of traders lose is because they do not know when the market will start moving in the direction. See, they might know that the market will go up or that the market will go down, but the when is extremely important, and that's what I teach students at Learn Forex Mentor. So if you're serious about Forex trading and you want to trade Forex professionally, sign up for my mentorship program and I will work with you one-on-one and help you to become successful as a trader. Now, did you learn what Forex trading is, how to trade the Forex market? Did you learn that The Forex market moved just like any other market. Did you learn the different types of orders used in Forex trading? Did you learn how to place a trade on the Forex market? Did you learn how you can earn money trading Forex? And did you learn how you can protect yourself should the trade not go your way? Now, the answer to all these questions should be yes. If the answer to all these questions is not yes, then go over these lectures again. Here we have the MT4 platform. Now this is a platform used by traders to trade on the Forex market. Now here we have the price levels, okay? So over here we have the price levels, and here we have the time and the date. So we have time and date here, we have price levels here. Now below the time and date, we have the different currency pairs. Okay, we have New Zealand USD, Euro JPY, Australian USD, etc. We have the different currency pairs here. Now, here we have our candlestick charts. Now, each of these candlesticks represents a moment in time, and you can select the time frame over here. Here we have the different time frames. So, for example, we're currently on the 1 hour time frame. So each of these candlesticks represents 1 hour. Okay, we can go to the 15 minutes time frame here, and now each of these candlesticks represents 15 minutes. Okay, and we can also go to the daily time frame, we can go to the weekly time frame, the monthly time frame, etc. Okay, the highest time frame we have is the monthly time frame. So each of these candlesticks represents 1 month. Okay, now beside the candlesticks, we have the tools. Over here, we have the tools. We have our Fibonacci tool. We have text, so you can add text to the chart. If you want to add a text, for example, ABC, you can add text to the chart. Here you can check your font, the size of your font, and the color. Okay, so we can add text, we can add squares, etc. Now, also here we have the trend line. So let me draw a trend line. Now the trend line is one of the most powerful tools used in Forex trading. Okay, we use this tool to help us to find turning points in the market. So here I have a trend line on my chart. If I want to remove this trend line, I just simply double click here, then I right click and I click delete. Okay, I can also edit this trend line by going here on trend line properties. I can choose if I wish for this trend line to show on all time frames, or I can click this and then I can select the specific time frame that I want this trend line to be visible on. Okay, so that's that. We can also click ray. If I click ray, this trend line will now become a ray. Okay, a long ray. Okay, so let me remove this trend line here. Now you can always customize your chart. For example, I'm going to customize this chart. Now all you need to do is right click the chart, click properties here, and now you can customize the chart to whichever color you choose. Okay, you can choose red, yellow, blue, any color you choose. You can also choose a color scheme from here. We're currently on black on white. You can go on green on black, or you can go on yellow on black, any color you choose. Now I'm going to add some indicators to this chart. Now to add indicators, just go over here and you click this button here, and here we have a list of all the indicators that are on this platform. I'm going to add the volumes indicator. So I'm going to click volumes, and here we have the settings for my volume indicator. Select the size line that I want, and my visualization is set to all time frames. Everything is good, and now I just click OK. And now my volume indicator is on my chart, just like my moving average indicator is on my chart. Okay, so now you can save templates. For example, if I don't want to add volume indicator to every chart individually, I can just save this template. So just right click the chart, click templates, click save template. You can put whatever name you want for the template, or you can set the template as default. Okay, so we put this template as default, we click save, and it's going to say, do you want to replace it? Click yes. And now whenever I open a new chart, I will have my volume indicator on that chart because this template is set as default. So let me go ahead and do that. I'm going to delete these currency pairs here. So to delete a currency pair, just right click, close. Okay, right click, close, right click, close, right click, close, and that's it. Okay, so I close all these currency pairs, and now I'm going to reopen those currency pairs. I'm just going to go over here to where it says create new chart, click this button, and now you can add any chart you want. Just click it. For example, I'm going to add the GBP USD. Fantastic, we have the GBP USD, and you notice that I have my volume indicator on this chart and the moving average indicator on this chart. That is because my template is set to default. Okay, my customized template is set to default, so whenever I add a new chart, it will automatically have my indicators and my customization. So let's add the Euro USD, let's add the USD JPY, let's add the USD CAD, let's add Euro JPY. These are the currency pairs that I mainly trade. Euro JPY, Euro USD, GBP JPY. I'm going to add all these currency pairs, and the Euro Aussie. Okay, Euro Aussie. You can really make money with this currency pair because it moves hundreds of pips in no time. For example, from here to here is 1,600 pips. Okay, that's a lot of pips. Now, okay, so we add the currency pairs that we want. Now you can zoom in on the chart. Just click here, you zoom in on the chart, or you can zoom out by clicking here. Okay, you can also go in the past by clicking your screen and scrolling back just like this, and we can go in the past. Okay, go in the past, and if you want to go back to the present, just click here and you'll be automatically taken back to the present. Now you can change the chart from candlesticks to line or bar chart. Okay, but we mainly use candlesticks because candlesticks gives us candlestick patterns, and we can use candlestick patterns as buy and sell signals. Okay, and that is explained in this course. In this course, you will learn how to use candlestick patterns as buy and sell signals. Now let's look at how to place a trade. Okay, how to place a trade. Now if you want to place a trade, just go here that says new order, click new order, and you can place a trade. So let's, for example, I want to place a trade. I want to place a trade with one lot. Here you can choose the volume of your trade. One lot, 10 lots, etc. One lot, depending on your account size, is $10 per pip. So if I'm trading one lot and I make 100 pips, I just made $1,000. Now, if you have a small account, one lot may just mean one pip. Depends on the size of your account. Now, we have stop loss. Then you can set your stop loss by simply clicking here, and you can set the amount of risk that you wish to put on the trade. You can also set your profit target here by clicking here, and you can set your profit target, the amount of profit that you wish to go for on that trade. Now, if you're ready to place a trade, just click buy, and the trade will be instantly executed because we have the type here, market execution. If you want to set a pending order, you click pending order. Okay, and with pending order, we just select a price, a future price, and if the market reaches that price, that's when the trade is executed. For example, I can put a pending order at this level here. Now, if the market comes to this level, my trade will be executed. Okay, so if I put a buy pending order here, pending order to buy this New Zealand USD, once the market comes down, I will be automatically entered in this trade. So that is a pending order. Now, if you want to place a trade, you can just click buy now, buy, and we're automatically entered in this trade. If you want to set your stop loss, you can click on the green line here, go down, and you will see this. You click I accept, okay, do it again, and your stop loss is set. So here I have a stop loss that is 25 pips. I can now put a profit target here. Now my profit target is 47 pips. Stop loss is 25 pips. Now, if you want to see this trade, you can also click here, terminal, and you will see this trade. Just go over here that says trade, and you will see your current trade. You will see your stop loss. You will see your take profit. You will see your size. Your trade is a buy. Here is the time, and here is your entry price. Okay, and if you want to close, you can simply click here and you close that trade, or you can right click on your screen here and click close, and it's just like that. You're out of that trade. Okay, just like that, you're out of this trade. And if you're not seeing all the currency pairs that you want, just right click and click show all, and this will ensure that you have all the currency pairs, okay. Now, if you want to open a new account, just click open an account, or you can, if you're logged out of your account, you can always click on file and go on to login to trade account. And yeah, you can change the language here. You can click here, so you can see as much charts as you have opened down here. Now, if you want to go back to looking at one chart, just simply double click any currency pair down here. Okay, and we're back to normal. Okay, so that is it for this lecture. This is all you really need to know about the MT4 platform. I've been trading for years, and this is really what I find important about the MT4 platform. So go open a demo account. You can use the link in the next lecture to open a demo account and start getting familiar with the MT4 platform. Opening a Forex trading account. Now, this is the most important step to Forex trading, okay? You need to ensure that you're trading with a good broker. When I first started trading Forex, I used to trade with market maker brokers. That was horrible, okay? We don't trade with market maker brokers. We only trade with ECN brokers, okay? So whenever you're looking to open a Forex trading account, always search for an ECN broker. And here we have a very good ECN broker, FX Choice. We have been using this broker for a while now, and their service has been absolutely amazing. Great customer service. There's no issue with drawing your money. The trade conditions are great, absolutely amazing. We have had no problems with this broker. So very good broker so far. And best of all, they accept US customers, okay? So if you're a US resident, you can open a Forex trading account with FX Choice, because it is very difficult for US traders to find ECN brokers that accept US clients, okay? It is extremely difficult to find ECN brokers that accept US clients. So FX Choice is an ECN broker that accept US clients. They have great reviews. So you can start trading Forex. You can open a live or demo account here. by the end of this section, you will understand what Forex trading is. You will understand how to trade the Forex market. You will understand that the Forex market moves just like any other market. You will learn the different types of orders used in Forex trading. You will learn how to place a trade on the Forex market. You will learn how you can earn money trading Forex, and you will gain an understanding of how you can protect yourself should the trade not go your way. Now, Forex stands for foreign exchange, and the Forex market is the largest financial market with over $5.3 trillion traded daily. Forex market is way larger than the stock market. The Forex market is comprised of over 4,500 banks worldwide, and currencies are traded through a broker and traded in pairs. For example, we have the Euro USD pair, we have the British Pound JPY pair, and we have the Australian Dollar USD pair. So currencies are traded through a broker and are traded in pairs. The Forex market until 1995 was not accessible by small investors. Only banks and large network investors had access to the Forex market. Okay? There are 6 major currency pairs. We have the Euro USD, the GBP USD, USD Swiss, USD JPY, USD CAD, and we have the Australian Dollar USD. Okay, so these are the 6 most traded currency pairs. Now, there are over 60 different currency pairs, but these currency pairs are the most traded currency pairs. Now, the Forex market have very deep liquidity. The Forex market is the most liquid market there is. So 24 hours a day, there are trading opportunities in the Forex market. You can trade at any time of the day. The Forex market it's open 24 hours a day, and it's extremely liquid, so you can trade at any given time. Now, the Forex market is also accessible from anywhere in the world. So it doesn't matter where you are located, you can trade on the Forex market. Okay, so let's say the US dollar is expected to weaken in value relative to the euro. A Forex trader in this situation will use his dollars to buy euros. If the euro strengthens, the purchasing power to buy dollars has now increased. The trader can now use the euros to buy back more dollars than they had to begin with, making a profit. So this is essentially what Forex trading is. It is trading one currency pair, so it is trading one currency against another currency. So if we believe the euro will rise in relation to the US dollar, we would buy the Euro USD currency pair. And if we think the euro would fall in relation to the US dollar, we would sell the Euro USD currency pair. So that's essentially what Forex trading is. It is trading one currency pair in relation to another. So if we believe that the pound will rise in relation to the Japanese dollar, we would buy the GBP JPY. Okay, so that is essentially what Forex trading is. Now here we have a trading chart, and as you can see, Forex trading is really trading price over time, and we use pips to calculate our profits. And what a pip is really just a very small measure of change in a currency pair in the Forex market. So here we have a pip. Okay, this 7 represents a pip. If the market moves from 67 to 68, then we have a 1 pip move. If the market moves from 67 to say 70, Then we have a 3 pip move. So that's essentially what a pip is. And we use pips to calculate our profits in the Forex market. Now, Forex trade sizes. We have a micro lot, which is a 1,000 unit trade, which represents $0.1 per pip. We also have a mini lot, which is a 10,000 unit trade, and this represents $1 per pip. We also have a standard lot, which is a 100,000 unit trade and represents $10 per pip. Now, trading Forex, you should never risk more than around 3% of your account. Okay, some traders may risk 4%, but you should never risk more than around 3 to 4% of your account on any given trade. So if you're trading, say, $500, you should not be trading a standard lot. If you're trading $500, you should not be trading a standard lot, because then you're risking too much. Now, the reason why Forex trading is so lucrative is because of leverage. So for example, if you invested $1,000 in the stock market, you bought 10 shares and the market moves 1 point, your profit would be a 1% profit. But if you had invested that $1,000 in the Forex market and the market moved 1 point, which is essentially 100 pips, then your profit would have been $1,000. That is a 100% return. This is why Forex trading is so lucrative, because you can literally risk a small amount and gain a large amount of money. Now, when you enter a trade by buying, you have to exit by selling. And when you enter a trade by selling, you have to exit by buying. Now, this is done automatically. So whenever you take a trade, whenever you place a trade, say, for example, you buy the Euro USD, when you choose to close that trade or whenever you choose to take your profit, the market will automatically do the opposite and sell to get you out of that trade. Now, when the market is moving upwards, we say it is rallying and your trade position is long or bullish. When the market is falling, your trade position is short or bearish. Now, 95% of traders are losers. And the reason for this is lack of education. A lot of traders think they can just get up and trade the market successfully. No, you can't do that. In order to trade successfully, you have to get educated. You have to get yourself the right education, find a mentor, get a mentor to show you the ins and outs of the market, to give you the experience that he has. You have to get the right education before you start to trade. Okay, so education is key. Now, the Forex market is open 24 hours a day from Sunday at 5 p.m. Eastern and closes on Friday at 4 p.m. Eastern time. And over each 24-hour period, we have 4 different sessions. We have the New York session, which opens at 8 a.m. Eastern and closes at 5 p.m. Eastern time. We have the Tokyo session, which opens at 7 p.m. Eastern and closes at 4 a.m. Eastern. We have the Sydney session, which opens at 5 p.m. Eastern and closes at 2 a.m. Eastern. And the most traded session, which is the London session, opens at 3 a.m. Eastern and closes at 12 noon Eastern. Now, the best times to trade are when sessions overlap. And this is because there are more traders actively participating in the market when sessions overlap. And this means greater liquidity in the market, which means that if you enter the market, there's a greater opportunity that prices will move larger distances as more traders are actively trading the market at these times. So we see at 8 a.m. Eastern to 11 a.m. Eastern, the London session and the New York session overlap. Now, this is one of the best times to be trading, from 8 a.m. Eastern to 11 a.m. Eastern. We also see that from 19 to 1 a.m. Eastern time, the Sydney session and the Tokyo session overlap. So it's best to trade when sessions overlap, as this will give you greater opportunity and will make trading a lot easier for you. Now, the PMI, which stands for Purchasing Managers Index, is correlated to the GDP. Okay, so we can use the PMI data for a specific quarter to also give us an understanding of what to expect for the GDP. Now, what is the PMI? This is an indicator of the economic health of the manufacturing sector, and it is based on 5 components. We have new orders, we have inventory levels, we have production, we have suppliers' deliveries, and we have the employment environment. So there are 5 components of the PMI data, and the employment component is extremely important because this can be used to help to predict the non-farm payrolls data and to give you an understanding of what to expect for the unemployment rate. Okay, so the PMI data is extremely important. Now, ADP can be used to help us to get an understanding of what to expect for the non-farm payrolls. Now, the US ADP report is a report that measures the number of non-farm private sector employment. So it's a report that can be used to give you an understanding to expect for the non-farm payrolls. Okay, the ADP only focus on non-farm and private sector employment. Now, with Forex, anticipation is key. In Forex, the anticipation of the news has a greater impact than the actual news. And for example, if we know the federal bank is planning on raising interest rates, this will have a greater impact on the market than the actual raising of the interest rates. And this is because the Forex market is speculative. The Forex market is largely driven by speculation. So the actual news outcome is not as important as the anticipation of the news. Okay, so the anticipation is key. If the market is anticipating a rate hike from the federal bank, we can expect a general increase in value for the US dollar. And that is because anticipation is key. Always try to identify what the market is anticipating. And one way to do this is to pay attention to the central banks. Okay, so always remember the Forex market is a futures market. So the market is always anticipating what is going to happen next. Anticipation is key. Now, here is an example of a fundamental trade. This is a trade you could have taken using fundamental analysis. Whenever there is economic uncertainty and things are not going so well, we have risk aversion. So once you understand the concept of risk appetite and risk aversion, you could have made money this week. Now, the US bombed Syria on the 7th. They bombed Syria on the 7th. Now, US bombing Syria, what does that mean? Does that mean the US is going to enter the war against Syria? It creates economic uncertainty. And once we have uncertainty in the market, we have risk aversion. So the trade, whenever we have risk aversion, the trade is buy Japanese yen. And that is exactly what you should have done, and you would have made a lot of money. So the market opened here, and you could have entered the market anywhere in this region. Maybe put your stops above these highs. So maybe a 50 pip risk on this trade would be good. And prices fell over 180 pips. Simple fundamental trade, okay? Once you understand risk appetite, risk aversion, you could have taken
this trade. So this is an example of a trade you could have taken using fundamental analysis, understanding market sentiment. Here we have risk aversion in the market, and that is why we have a stronger Japanese yen. So this was a simple trade, risk aversion, and the USD JPY fell over 180 pip. The Aussie JPY also fell, right? And you could have taken this trade anywhere in this region. The market opened here, and you could have taken this trade at the weekly pivot, okay? You could have sold somewhere here, stops above this high. That's about a 55 pip risk. Market fell over 150 pips. And this can continue going lower, because if the market sentiment remains the same, we will expect lower prices. Pay attention to the news. Okay, so in this lecture, I'm just going to discuss some of the news sources that you can use to keep up to date with what's happening in the Forex market. Now, you can go to Bloomberg.com and you can read articles in the currency section. Now, pay attention to articles that gives information on the reasons for a particular move in the currency and analysts' expectation for the possible continuation of that move. Okay, so we mainly want to focus on articles that gives us a reason for the move. If we see the New Zealand USD falling, we want to pay attention to articles that can give us the reason for that move. For example, the article can read, the New Zealand USD has fallen, let's say 100 pips as a result of falling dairy prices. Okay, so that's a good example of an article that gives you the reason for the move. Now, the next news source that you can use is fxstreet.com. Okay, you can go to fxstreet.com and you can use the economic calendar. This allows you to see a list of the economic data that will be coming out. If we want to know when we will have the CPI data, we can go to fxstreet.com and we can look on the list of economic data that will be released this week. So we can use fxstreet.com to get the fundamental announcements. Okay, and there are several fundamental announcements each and every day for different currencies, and they are released every single trading day. Okay, so that is a very good news. So you can use forexfactory.com. They also have an economic calendar. You can use the economic calendar at forexfactory.com, and you will also see a list of the economic data that will be released. Now, as it pertains to news feeds, you can use randsquat.com. This is a real-time news feed and analyst service. It's a premium service, so it's a bit expensive, okay? But it's something that you can also use as a news feed. Also, I share the news feed that I use with the students of my courses, okay? So you can go to www.loretatrade.com and you can sign up to use the news feed that we use at Loreta FX. It's a small fee. It's about $25 a month. And you get to use the news feed that we use at Loreta FX. Okay, so those are news sources that you can use. You can use FX Street. You can use runsquat.com. And there are tons of other news sources. Now, section recap. Now, remember, focus on the central bank. Okay, we need to focus on what the central bank is focusing on. And this will normally be one or two things. Normally only one thing, except for the US, which has a dual mandate. Okay, so focus on the central bank. Whenever we get a news release, we should always be thinking, how will this affect how the central bank views the economy and inflation? So always focus on the central bank. So we find out what the central bank is focusing on via the news, and we use this information to decide which currency to be trading and in which direction. And the news sources, again, you can use Bloomberg.com, FXstreet.com, Forex Factory, RunSquawk, Forex Live, and you can also use the service that we provide at LoretaTrade.com. Okay, so that's it for this section. Yeah.
Okay, so the first step is to get an understanding of what is happening in the market. So the first thing you will do is you will go on this page, read through some of these stuff, get an understanding of what is happening on the market. Then the next thing you will do is you would go on market sentiment and you would get an overview of what was causing yesterday's market sentiment, what caused the previous session market sentiment, and what is driving the current market sentiment. Okay, so here you will see what is driving the current market sentiment, what drove yesterday's market sentiment, stuff like that. Okay, so you have to read these, get an understanding of what was driving market sentiment yesterday and what was driving market sentiment in the previous market session and what is currently driving market sentiment. Once you understand that, go on currency fundamentals and get an understanding of what's the overall fundamental outlook of the currency. For example, the Canadian dollar is weekly bullish. So we will look to trade fundamental announcements that are bullish for the Canadian dollars. Or you see the fundamental outlook for the Australian dollar is weekly bearish. Okay, so we're looking to sell the Australian dollar, stuff like that. So we get an overall understanding of the fundamental outlook of the currency. Now the next step is to go to the economic calendar. So you go to the economic calendar and you look on the upcoming fundamental announcement. So you look through the economic calendar and get an idea of the fundamental announcements that have been released yesterday and the fundamental announcements that will be released today and the fundamental announcements that are going to be released next week. What you're going to do now when you're trading is you're going to look to trade fundamental announcements that agree with the fundamental outlook of a currency. For example, given the fundamental outlook for the Australian dollar is bearish, then we want to trade fundamental announcements for the Australian dollar that comes out worse than expected. So this is a news feed that we use, and as you can see, we have all categories. Here you will see everything that's happening on the news feed. Here you see currency fundamentals. Here you can get the overall fundamental outlook of the currencies, if they are weekly bullish, or bearish. And here we have institutional levels. So here you can see buy orders in the market. Okay, you can see sell orders, buy orders. So you can see where a lot of sell orders are and where a lot of buy orders are in the market, and you can use that to help your trading. Also remember, option expires. The market is attracted to large option expires. For example, this one is 1.3 billion. So the market will be attracted to this price level. There's also market sentiment that you can use to get an overall outlook of the market sentiment. Here you see the current sentiment, the main data released in the US. Okay, you can look on yesterday's sentiment, stuff like that. So yeah, that's market sentiment. Then there's resources where you can download the indicator, the templates. Then we have trade signals. Here you will see some of the trade signals from some of the major investment banks. For example, Morgan Stanley placed a limit order to buy the USD CAD. Here you see the reasons why these guys bought the USD CAD, etc. So that's extremely helpful. Credit Suisse also went long the USD CAD. Here you see the reasons, and you see these guys entry, their target, etc. So that's also good. Okay, you can see the release of fundamental announcements. There's bank analysis, etc. So that's that for the newsfeed. Also, we have the course. Okay, so you can go back through the fundamental course, and that's that for the newsfeed. Okay. Okay, so this is the Australian dollar currency pair, and we're just going to look at some fundamental trades. So the first step is to get an overview of what's happening in the market. And you can do this by visiting the news sites such as Bloomberg Currencies, forexlive.com, etc. Or you can use the news feed to get an understanding of what's happening in the market. The next step is to understand what was driving yesterday's market sentiment. Then you get an understanding of what was driving the previous trading session sentiment. And once you understand that, then you have to analyze the current market sentiment and identify what is driving the current market sentiment. And you can do that by using news feeds or going to the news sites. Now, when trading fundamental analysis, we prefer to trade in the direction of the fundamental outlook of the currency. However, there are times when you may get bullish trade on currencies that have a bearish fundamental outlook, but these trades are normally short-term trades based on sentiment change. Okay, now when trading fundamental analysis, we don't just enter the market at any price. We look for what is called a good price, and good price is when the market reaches, for example, a resistance or a support, a pivot point level, a 200-day moving average, or a Fibonacci level. Okay, those are what we call good points, and those are the points that we look to enter the market. For example, okay, if we're looking to sell this, we would not sell the market here. We would wait for a pullback and look to sell somewhere in this region. Why? Because here is a past support, future resistance. So we look to sell somewhere around this region. Okay, so we draw a horizontal line here. If the market is here right now, we would love to see the market come to this level before we look to sell. Also, this is where the 200-day moving average is, and this is the average price of the market. So if the market reaches a 200-day moving average, that's a good price to also sell. Just depends on your risk appetite. The next thing we use is the Fibonacci. We use this tool, the Fibonacci, and we draw it from the lows to the highs like this, and we look to enter at what's called the 5-0 level, the 5-0 level on the 618 level, which is this level and this level. In this region is what we call the kill zone. This is the region where we look to enter the market when trading fundamental analysis. Okay, so we look to enter the market in the kill zone. So if we're going to trade this, we're going to wait till prices reach to this level. Right around this level, here's a 200-day moving average. So prices would be a little bit above the 200-day moving average, and it would be right in the Fibonacci zone. Right, it will be in the Fibonacci zone, and it would be near the past support, future resistance level. So this is a good sell, but we can't just sell this market like this. We have to sell it based on the fundamentals. So what we're going to do is we're going to go to the economic calendar. This is the, say for example, this is the 26th of April, right? So this is 26, and we're going to look for the 26th of April. And we're going to look to sell the market before a fundamental announcement. So you can sell the market after the fundamental announcement. You can trade after the fundamental announcement, or you can trade before. It just depends on the risk and the analysis of the trade. If you know that the fundamental announcement is going to come out bad, then you can enter the market before. If you're not sure, then it's best to wait until the release of the fundamental announcement, then you enter the market. For example, on April 27th, we have consumer prices for the Australian dollar. Now, this is a high volatility economic indicator. It's going to cause high market volatility. So prices are going to move whenever this announcement is released. So April 27th is when we're going to get this. So if you're trading, for example, if you're trading here, which is the 25th, it's best to wait until April 27th to enter this market. Okay, because that's when we're going to have CPI indicator for the Australian dollar. It's going to be April 27th. So you wait until the 27th. So as you can see, the market rallied and it came right into what we call the kill zone. Remember the 5-0 level and the 618 level, right with the past support, future resistance. So this is the kill zone, and it's also near the 200-day moving average. So this is the kill zone, and we're expecting the CPI data to come out worse than expected. And that's because we're following the news feed, and we understand that most analysts are expecting the CPI data to come out worse than expected. So we're looking to sell this Australian dollar right around this level. So you can sell it before when the market is anywhere in this region which stops above the high, so you'd have to risk a 100 pip stop, okay? Or you can sell after the event, which means you would enter the market somewhere around here. You would enter the market somewhere around here, and your stops would have to be up here. So as you can see, CPI data came out worse than expected. It was expected to come out at 1.8%. The previous was 1.7, and they were expecting 1.8, but it actually came out at 1.3%. So this is worse than expected. So as a result, the market fall. And why did the market fall? Because poor CPI data. Remember, interest rates is the fundamental driver of market prices. So if CPI comes out worse than expected, then that's telling us that the central bank may lower interest rate, because they're going to lower interest rate to try and increase the CPI. They're going to try to increase market demand by lowering interest rate, increasing the money supply, so there's more demand for products, which should cause prices to increase. So that's what we're expecting them to do. So whenever we have a bad deviation in CPI, meaning a worse than expected CPI reading, then we're going to expect these guys to be looking towards cutting interest rates. That's what we're expecting them to do after seeing this. Also, if you go to the news feed, okay, you can see that the market sentiment, it says this data directly plays into the RBA's monetary policy decision, and this miss has greatly increased chances of an RBA cut at the May 3 meeting. Okay, so with the probabilities jumping to nearly 50% after the release. So most fundamental traders now are expecting these guys to cut interest rates. Okay, so after reading the news feed and finding out that there's a 50% chance of these guys cutting interest rate at the May 3 meeting, we're looking to sell the Australian dollar USD. But we can't just enter the market here, so we have to wait. We have to wait until close to May 3 before we sell the market, because it's so far down that we're going to wait to see it come back near to the average price, which is a 200-day moving average. We want to see it come back closer to the average price. Also, we want to see it come to the past support, which is this level, which will become future resistance. So we want to see prices come somewhere near here, right? We want to see prices come somewhere near here before we look to sell. Also, near the moving average, the 200-day moving average. So we like to see prices come to this region before we look to enter the Australian dollar. The next thing to use is the Fibonacci. Remember, we use the Fibonacci to help us to get a good price to enter the market. So you draw from the lows to the highs, and we're going to look to enter the market at the kill zone, which is this zone right here. The 618 zone is what we call the kill zone. So we're looking to enter the market somewhere in this region, which is right near the Fibonacci, right near the moving average, and the past support, future resistance. That's where we're looking to enter the market. We're looking to enter somewhere around here. So that's what we call good price. And whenever the market reaches this level, we're going to sell. Why? Because we're going to expect these guys to cut interest rate at the May 3 meeting. Okay, so on May the 3rd, we're expecting these guys to cut interest rate. And if they cut interest rate, the Australian dollar is going to fall. So remember the steps. You have to go to the news feed, get an update, and then you look to the economic calendar for the upcoming announcement. So now we're going to look on the economic calendar to see the upcoming economic announcements. So if we go on the economic calendar, we can see that on May the 2nd, we had bad data for the US. This was market PMI. It was on the 2nd of May, and it came out bad for the US. So if you go on the Australian dollar and you look on May the 2nd, let's see, which is right here, right around here is May the 2nd. This temporary up move that we have here may have been caused by the bad US data, by the bad market PMI for the US, which is bad. It came out worse than expected. We were expecting 51, and it came out at 50. So this is bad for the US. Okay, so that's a bad indicator for the US. But
the fundamental outlook for the Australian dollar is still bearish. Okay, these guys are looking to cut interest rate. That means their fundamental outlook is bearish, and they're still a bearish currency, which means this temporary up move is just a minor change in market sentiment. Okay, it's just minor. This is what we call minor change in market sentiment. The fundamental outlook is still bearish, so we're still looking to sell the Australian dollar. And as you can see, on May the 3rd, these guys did in fact cut interest rates. See, interest rates were at 2%, and these guys cut interest rate to 1.75%. So they indeed cut interest rate as expected. And what you see here is a rapid fall in the currency. See, falling, kept falling, kept falling. And that's because these guys cut interest rate. You would have definitely entered this currency right around this level. Okay, because this is our kill zone. This is where we're looking to enter. We're looking to enter near the announcement. So on May the 3rd, we're looking to enter the market. The minute the market reaches into this zone, we would enter, because this is the past support level, which becomes future resistance. This is the 200-day moving average, and this is the fib zone. Okay, so that's where we're looking to enter. So when you enter the market there, you'd have to put your stops above the highs. So you'd have to risk a 85 pip stop, and then your target is like 200 pips. And you would have made more than that if you had stayed in the market. If you had stayed in the market, then you could have made, if you had stayed in the market, you could have made 500 pips. Okay, you're risking 80 pips, and you could have made 500 pips if you're in the market. That's because the fundamental outlook for the Australian dollar is bearish. So every time the Australian dollar rises, we're looking to sell it. Okay, because it's now bearish. It's now a bearish currency because they're cutting interest rate. Okay, so we go back on the hour time frame. And so when you're looking to set stop loss orders and take profits, we use what we call the ADR indicator, the average daily range. And the average daily range is really the average distance for the day that the market is expected to move. For example, the average distance for this day might have been 160 pips. So we might have been expecting the market to fall maybe 150 pips, when in fact it fell. Let's see. Give me a second. When in fact the market fell for this day, the market fell 240 pips for this day. So the average daily range for this day might have been 120 pips, but it's as a rule that whenever there's a major fundamental announcement, the market can move like 2 times the average daily range. Okay, 2 times or more the average daily range, the market can move if there's a major fundamental announcement. So that was expected. So we use average daily range to help us with our take profit. Okay, so if we're expecting, if the average daily range is 120 pips, then our take profit might have been at 110 pips. So that's an example of how we use average daily range. But in a case like this, it's a major fundamental announcement where these guys cut interest rate. We're not looking to exit until the market falls 250 pips. That's when we might exit, and then we might look to enter again on a pullback. If the market comes to a good price, we enter on a pullback. For example, here is a good price. The market did not come to a good price. Here's the past support. Here's a good price. The market never did that. It fell. So there's no trade opportunity. Here is a good price. The market came to the 200-day moving average. Okay, and this is also, you draw your fib. You draw your fib. This is the 618 level. This is a zone here. The market went above that. However, okay, if you had sold the market here, put your stops at 70-60 pips, you would have made 140 pips. This is the 17th of May. And in the next lecture, we will look at this trade.
Okay, so we're back with Australian dollar USD currency pair. And remember, the Australian Central Bank has just cut interest rate. So the fundamental outlook for the Australian dollar is bearish. Okay? So remember now, before we trade, we have to go to the news feed. We have to identify the previous day's sentiment, what was causing the previous day's sentiment, what was causing the sentiment for the recent market session. So after you have done that, the next step is to go to economic calendar, because on the 16th when the market was here, we were waiting for the market to come to a good price before we enter. And the good price is around this level where the moving average is, also where the Fibonacci zone is. And then we also have this past support level, future resistance. So here is a good price to enter the market. So we're going to go to the economic calendar and we're going to look if there's any fundamental announcement that's going to be released. And then we're going to look to trade any good US data that comes out against the Australian dollar. So if we get a good US fundamental announcement, we're selling the Australian dollar in this region. Why? Because Australian dollar is fundamentally bearish. Okay? So we're going to sell the Australian dollar on any good US data. So you would go to the economic calendar, for example, FX Street. So we're looking for US data or Australian data or New Zealand data, because remember, New Zealand data affects the Australian dollar. Also, Chinese data affects the Australian dollar. So any of those data that comes out worse than expected, that's what we're looking to trade. And right around here, we have consumer price index, right? We have CPI for the US. And if this comes out better than expected, then we're going to sell the Australian dollar right around 12:30 GMT. And as you can see, these results came out better than expected, so these are good for the USD. Remember, any good data for the USD is a good reason to sell the Aussie USD currency pair, because the fundamental outlook for the Australian dollar is bearish. And right around here is when the CPI data came out. The market fell over 140 pips. Okay, so that's it. You remember, you draw your fib, you look for a good price, and a good price is near the 200-day moving average, past support becoming future resistance, Fibonacci levels, pivot points. Those are good price levels at which you can enter the market. Here the market is again, if prices come, this is past support, becoming future resistant. So this Australian dollar can fall, but we would not sell this as yet. We will go to the economic calendar and we will look for a fundamental announcement that coincides with this level, right? And then we will look to sell the Australian dollars and go for, say, 60 pips or more, depending on the average daily range. We trade the currency that is fundamentally bullish against the one that's fundamentally bearish. Or we trade a currency that has a current market sentiment that is bullish against one that has a current market sentiment that is bearish. Okay? So that's why the news feed is important. So you go to the news feed and you analyze the current market sentiment for each currency. For example, if you were trading the USD Canadian dollar, and let's say the current market sentiment is bullish for the US and the current market sentiment is bearish for the Canadian dollar, then we would look to enter a trade on the USD Canadian, buying the USD Canadian. Why? Because that's a sentiment trade. We're going to trade one sentiment against the other. Once the sentiment is good for the US, the sentiment is bad for the Canadian dollar, then we're going to trade it. But we're not just going to trade it at any price. We're going to look to enter the market at a good price. So we're going to use our Fibonacci and we're going to look for this level, the 5618 level. That's our kill zone. So we want prices to come back somewhere in that level. Also, we're going to use the 200-day moving average. So trend moving average, and we're going to use a 200-day moving average. Bingo. See this? So this is a good price to enter the market based on the sentiment. If we know that on May the 18th, the sentiment for the US dollar is strong,
and the sentiment for the Canadian dollar is bearish, then we're looking to buy the USD CAD at a good price. And a good price is a Fibonacci level or a moving average level or a past resistance level that has become future support. So this right here is a good level to enter the market. So this would be a good fundamental trade. If you had entered the market here, your stops could have been placed here, which is a 70 pip stop. You would have made 240 pips on the first rally. Okay, so that's a sentiment trade. That's how you can trade based on the current market sentiment and make money. So that's why it's good to have a news feed, because you look at the news feed and then you get an understanding of the current market sentiment. Maybe there's news that Saudi Arabia plans to increase oil production. And if these guys increase oil production, then oil prices are going to fall because there's going to be an excess supply in the market, which is going to decrease prices. Remember, supply and demand. So when there's excess supply, that's going to cause prices to fall. So if these guys decide to increase oil production, then that's a bullish sentiment for the US dollar and a bearish sentiment for the Canadian dollar. Because remember, Canadian dollar has a strong correlation to the price of oil because Canadian economy exports a lot of oil. So if oil prices are going to fall, then we're going to expect the Canadian dollar to fall. So that's an example of a market sentiment trade. If we hear that these guys are planning to increase oil production, then we're looking to buy the USD Canadian for a quick sentiment trade. And that's exactly what you could have done here. We would buy it at a good price, which is a Fibonacci level or a moving average or at a pivot point level. Okay, so we look for a good price to enter the market, and then we can use stuff like candlestick formation, stuff like that to give us a perfect entry. So here's another example of a fundamental trade. So we were expecting the New Zealand Central Bank to lower interest rate. Okay, we were expecting them to lower interest rates. So we were looking to sell the New Zealand USD. It was the 7th of September, but the rate decision was going to be on the 9th of September. So we would have to wait 2 days before we could sell the market. So prices were here, and we were waiting for price to come back towards the average before we look to sell. Also, we look for past support, future resistance. This was past support, future resistance, but prices blew through this past support, came all the way up to the 200-day moving average, and kept going higher. Now, we could have sold the market here, but this was the 8th of September, and we prefer to enter the market right before the fundamental announcement or a couple of hours before the fundamental announcement. So we were looking to enter on the 9th. This was the 8th of September, and we were looking to enter on the 9th. Right around here is where we look to enter. If you're selling the market here on a rate decision, you would have to put your stops above the highs. Not this high, because the market is right next to this high. So we would not put our stops at this high, but we would have put our stops at the other high. This is too close to this level, so we would not put our stops at this if we're trading a major fundamental announcement such as interest rates. Okay, so your stops would have to be a little bit higher. Somewhere up here is where you put your stops, and that's where we put our stops. We sold the market somewhere here after getting like this evening star candlestick pattern here. Sold the market, prices fell a little as expected, and then came back up, gave us this lovely tweezer top here. Prices came back up, gave us this lovely tweezer tops before the rate announcement, which was here. Before that, the market gave you a tweezer tops. Okay, and this is a sell signal. It's also at a resistance level, and it's also above the 200-day moving average. So it's a good price to sell the market anywhere here. We sold the market here. We were expecting these guys to lower interest rates. So that's the reason why we sold early, because we were expecting these guys to lower interest rates, and they did. As a result, the market fell. So what is risk appetite and what is risk aversion? Now, risk appetite is simply when the world economy is doing well, Investors have a positive outlook on the economy and they are more willing to take risk. Okay, so this is what we call risk appetite, when investors have more appetite for risk. While on the other hand, risk aversion is when economy is not doing so well and investors are not willing to take as much risk. That is what is meant by risk aversion. Investors are not willing to risk. Now, whenever there is risk appetite, we will get an increase in currencies that are high yielding currencies. Currencies such as the Aussie USD. Okay, whenever we have risk appetite, we will get an increase in these currencies. While whenever we have risk aversion in the market, we will get a decrease in these currencies. Now, one of the main reasons why sometimes we may get good data for the US and at the same time we can see the Aussie USD rises is because sometimes good US data creates risk appetite in the market. And whenever there is risk appetite in the market, the Aussie USD will rally. Also, whenever there is risk aversion in the market, the JPY will rally. Now, one way you can know whether there is risk appetite or risk aversion in the market is by paying attention to the stock market. If we get a significant increase in the stock market, that means risk appetite. While if we get a significant decrease in the stock market, that means risk aversion. So you can use the stock market to help you to analyze whether or not there is risk appetite or risk aversion in the market. Now, whenever there is risk appetite in the market, traders tend to perform what is called a carry trade. That is the buying of a high yielding currency and selling of a lower yielding currency. For example, buying off the Aussie USD. And that is exactly what we have here. This rally here is as a result of what we call a carry trade. There was extreme risk appetite in the market here, and as a result, we can see this nice carry trade here of about, let's say, 500 pip carry trade. Okay, the buying of the Aussie USD because there was risk appetite in the market. The stock market was booming. The Dow Jones were making highs of the highs, and that fueled this carry trade. So this is a nice example of a carry trade, and this is a technique that you can also use to trade fundamental analysis. Whenever we have risk appetite, you can look to buy high yielding currencies, and whenever we have risk aversion, you can look to buy low yielding currencies. You can look to buy the JPY. Okay, so that's it. Happy trading.
Now, by the end of this section, you will understand what are Japanese candlesticks. You will learn how to identify the various types of Japanese candlesticks. You will learn how to trade Japanese candlesticks. You will learn that Japanese candlesticks often indicates potential turning points in the market. Now, every Japanese candlestick have a high price, a close price, a open price, and a low price. If the close price is above the open price, we say the candle is a bull candle. And if the closing price is below the open price, we say the candle is a bear candle. Now, the high price is the highest price the candle went during formation, and the low price is the lowest price the candle went during formation. Okay, so every candlestick have a high, a close, a open, and a low. Now, for some candles, the open and the close are the same. Those are indecision candles. But for real body candles, all real body candles have high price, close price, open price, and low price. So here's an example of a candlestick chart. Candlestick charts are the most frequently used charts by traders. Now, a high is a candlestick pattern in which there are two candles to the right and two candles to the left that are lower than the high of the center candle. And a low is a candlestick pattern in which there are two candles to the right and two candles to the left that are higher than the low of the center candle. And here are some examples of highs and lows. Here we see an high. We have candles to the left, candles to the right that are lower than this center candle. Here we see a low. We have two candles to the left that are higher, and we have two candles to the right that are higher. So this is a low, this is a low, this is an high. So you get what a low and an high is. You have to have two candles to the left and two candles to the right that are higher or lower than the center candle. So now this candle here could not be an high. And that's because even though there are more than two candles to the left that are lower, there are not two candles to the right that are lower. Okay? Now, candlesticks with bodies longer than their wicks are called decision candles, while candles with longer wicks than body are called indecision candles. And here we have some examples. This is an indecision candle. This is a decision candle. Okay? Decision candle, indecision candle. Okay? Now, this is a hammer candlestick. This is a doji candlestick. This is a Marubozu candlestick. This is a gravestone doji candlestick. And we can use these candlesticks to help us to determine turning points in the market. Now, evening and morning star patterns can consist of more than 3 candles. The third or last candle of the evening star must close below the 50% mark of the first candle, and likewise, the third or last candle of the morning star must close above the 50% mark of the first candle. So here we have a evening star, and this candle, which is the third candle, must close below the 50% mark of this candle, which is the first candle, for this to qualify as an evening star. Likewise for morning stars. This candle, which is the last candle of the pattern, must close above the 50% mark of this candle, which is the first candle of the pattern. And evening and morning stars can be made up of several candles. It does not have to be 3 candles. It can be several candles. It can be 8 candles. Now here are some examples of evening stars and morning stars. Here we have a morning star, and in this example you can see that the morning star is made up of several candles. Okay? So morning star, market rallies. Evening star, market falls. Now, tweezer tops and bottoms consist of 2 or more candles with wicks that are at least 60% the length of the total candle. Now, the bodies of the candles can be bullish or bearish. It doesn't matter. The bodies don't matter. The ideal tweezer top or bottom have wicks that are similar in length. Okay? And tweezer tops can be made up of several candles, just like morning stars and evening stars. So here are some examples of tweezer tops and bottoms. Here we have tweezer bottom, market rallies, tweezer top, market falls. So you can see that these candlestick patterns signals reversal in the market, and they are extremely powerful when used along with the trend. Now, bullish or bearish engulfing candles are candles that engulf the previous candle or candles. A bullish engulfing candle engulfs the previous bearish candles after a downswing price move, and a bearish engulfing candle engulfs the previous bullish candles after an upswing price move. So here we have an example of a bearish engulfing candle, and here we have an example of a bullish engulfing candle. So these candles engulf the previous candle or previous candles. Now here are some examples of engulfing candles. Here we have a bullish engulfing candle. Market rallies. Another bullish engulfing candle. Market rallies. Another bullish engulfing candle here. And you can see that the market responds to these candles, especially when they appear in the direction of the trend. Here we have another example, a bearish engulfing candle. Here we have another bearish engulfing candle, and here we have another bearish engulfing candle. Now pause this video and see how much candlestick patterns you can identify. Okay, so we have an evening star right here. We have another evening star right here. We have a tweezer bottom here. Market rallies. We have engulfing bullish candle. Market rallies. We have evening star. Market falls. We have engulfing bullish candle. Market rallies. We have evening star. Market falls. We have engulfing bearish candle. Market falls. We have evening star. Market falls. So you see, the market listens to these candlestick patterns. Tweezer tops, market rallies. Engulf evening star, market falls. So candlestick patterns can be extremely powerful. Now pause this video again and see how many candlestick patterns you can identify. Okay, so here we have evening star. Here we have engulfing bullish candle. However, the market did not rally. So nothing is 100%, but that is why it's important to trade these candlestick patterns with the trend. Here we have a morning star. Market rallies. Here we have tweezer bottoms. Market rallies. Here we have another engulfing bearish candle. Market falls. Engulfing bullish candle. Market rallies. We have tweezer tops. Market falls. Morning star. Market rallies. So the market listens to these candlestick patterns, and they are extremely powerful when used along with the trend. Now, on most occasions, the market will test candlestick formations. For bullish candlestick patterns, the bears will test the lows for selling interest. If there's no selling interest, the pattern would hold and prices will rally. Now, if it's a bearish candlestick pattern, the bulls will test the highs for buying interest. If there is no buying interest, the pattern will hold and prices will fall. So this is the reason stop loss orders have to be placed above the highs and below the lows of candlestick patterns. Okay, so the market will on several occasions test candlestick patterns. This is something that you should know and something that you should trade expecting. You should trade expecting the market to test the candlestick pattern. So here we have an example. So here we have tweezer bottoms. Now, Say for example, you saw these tweezer bottoms and you bought the market. So you would buy the market after seeing the tweezer bottom. So you would have entered the market around this price. Okay? Now you enter the market and the market begins to rally. And then the market begins to test the candlestick pattern. You see how much times the market tests the candlestick patterns here? We see the first test, second test, third test. So on several occasions, the market tests these tweezer bottoms. And then we see the market rally. So always remember and always trade expecting the market to test the candlestick pattern. So this is why if you're buying these tweezer bottoms, your stop loss order has to be below the wick of the tweezer bottom. Now, do not trade candlestick formations in consolidation. This is extremely important as on several occasions you will get fake signals inside consolidations. Now, trade candlestick formations in the direction of the trend after a retracement. Trade candlestick formations at Fibonacci levels and at trendline bounces. When trading candlestick formations, ensure that stops are placed couple pips above the formation when selling and couple pips below the formation when buying. One of the main rules to trading is if the risk of the trade is too much, do not take the risk. And this is extremely important. Successful traders become successful not just because of how much they make, but because of how much they do not lose. Now, candlestick formations allow you to have very little risk on the trade. So remember, keep your losses small and let your profits run. So here we have an example. Here we have an uptrend. The market pulled back or retraces and we get a candlestick pattern. Okay, so uptrend, market retraces, and we get a candlestick pattern. Here we have an engulfing bullish candle. And as a result, the market rallied. So if you had bought this engulfing bullish candle and placed your stop below these lows, you would have made a lot of money. Okay, so candlestick patterns can be extremely powerful when used along with the trend. Now, did you learn what are Japanese candlesticks? How to analyze trading charts through the use of Japanese candlesticks? Did you learn how to identify the various types of Japanese candlesticks? Did you learn how to trade Japanese candlesticks? And did you learn that Japanese candlesticks often indicate potential turning points in the market? So if the answer to all of these questions is not yes, go back through these lectures again. Now, by the end of this lesson, you will understand what are trend lines and how to draw trend lines. You will understand the significance of trend lines. You will learn that trend lines act as levels of support and resistance. You will learn how to trade trend line breaks and bounces. And you will get an understanding of the ABC price wave movement and how to identify these movements. A trend line is a straight line that connects two or more points of support or resistance in a trend. And a trend line may act as support or resistance for a trend. Now, an uptrend is when the market is making higher highs and higher lows. And a downtrend is when the market is making lower highs and lower lows. So here we have two examples. Here we have an uptrend and here we have a downtrend. Okay, so you can see higher highs, higher lows. Okay, and here in the downtrend we have lower lows and lower highs. Okay, these are support, these are resistance. Okay, support, resistance. These highs, resistance, support, support. Okay, so a trend line is a straight line that connects two or more points of support or resistance in a trend and act as a line of support or resistance for that trend. Now, there are three main categories of trend lines. We have the short-term trend line, also known as the inner trend line. We have the medium-term trend line, also known as the outer trend line. And we have the long-term trend line. Okay, so there are just three categories of trend line. And later on in the course, I will teach you how to draw these three types of trend lines.
Now, by the end of this section, you will understand what is market sentiment and how it can affect prices. You will learn how to go about trading the fundamentals. You will learn how to predict the possible results of some fundamentals using correlation. And you will learn one of the major keys to successful Forex trading and how you can use this key to make more money trading Forex. Now, fundamental trading. Now, first we must identify the reason for the move. So first, identify the cause of the move using the news sources. Is it because of an economic announcement? Is it because of rising oil prices, etc.? Okay, so once we say that the market has moved, we must first identify the cause of that move. Okay, once we understand the cause of that move, then we can anticipate the other move. So the first thing is to identify the cause of the previous move, and then we can go ahead and try to anticipate the upcoming move. So the first thing to do is to try to identify the reason for the previous or the most recent market move. The next thing is the fundamentals. You must identify the overall fundamental picture of that currency, and you can do this by using news sources to find out what the central bank is focusing on and which way the currency should be going. If the central bank is focusing on increasing interest rate, then we're going to expect the currency of that central bank to increase. Okay, if a central bank is focused on quantitative easing, then we're going to expect the currency of that central bank to decrease in value. And then you must identify a fair price for the currency. Okay, so you must identify what is the fair price of the currency based on the cause of the most recent fundamental announcement. Okay, so for example, let's say we have CPI data coming out for the US, and as a result, we can say the euro falls to, let's say, for example, 105. Now that's a fair price because that's where the euro went after we had the CPI data, the most recent fundamental announcement. Now let's say the next day we see the euro falls to 107 and there's no fundamental announcement, no major economic news that should cause the market to fall. Okay, in that case, the fair price for the euro is 105 because the fall to 107 is not caused by any fundamental news. Hence, the fair price of the currency is still 105. Okay, so that should give you an understanding of what fair price is. So first, understand the reason for the move. Then we get the fundamental outlook for the currency. Then we identify what the fair price is. And then we can move on from there. And further on in the course, we will discuss the steps to trade in fundamental analysis. Sentiment. Now, this is extremely important. And what sentiment is really the mood of the market. Okay, very often the fundamentals may point towards the market moving up, but instead the market moves down. And this is often just a change in sentiment and it's temporary. Okay, so sentiment is just the mood of the market. And changes in price that are caused by sentiment are temporary. The market will eventually move in the direction of the fundamentals. So sentiment change may be caused by traders taking profits, And as a result, we see a temporary change in the direction of the market. But as long as the fundamentals remain unchanged, the market will eventually go in the direction of the fundamentals. Okay, so sentiment is the mood of the market. And a technique we love to use to trade is to trade the sentiment of one currency against the sentiment of another currency. And we will discuss this further on in the course.
Now look for the most recent ABCD pattern and draw a trend line connecting the latest A to the latest C. This will be your short-term trend line. Look for the lowest A and draw your trend line using the rules you've learned. This will be your medium-term trend line. And compress your chart or go to the larger time frame to draw the long-term trend line. Okay? Now here's an example showing the long-term trend line, the medium-term trend line, and the short-term trend line. We see the short-term trend line is drawn from the most recent A and C. Okay? Then we have the medium-term trend line and the longer-term trend line. Now pause this video for a second and see if you can identify the short-term trend line and the medium-term trend line. We see the most recent ABCD pattern, A, B, C, D. So we connect the A's and the C's, and we have the medium-term trend line. Now in order to get the long-term trend line, you will need to compress your chart or go to a larger time frame. Pause this video for a second and try and identify the short-term trend line and the medium-term trend lines. Okay, so here we have the short-term trend line. The market has made a lower low or a lower B, so this is the most recent ABCD pattern. A, B, C, D. The market has made a lower low. Now, if the market had not made a lower low, then the inner trend line would have to be drawn from this A, B, C, D. Okay? However, the market has made a lower low. So now the most recent ABC pattern is this one, A, B, C, D. So always remember, if the market has made a lower low, draw the trend line using the most recent A, B, C pattern. And for the medium-term trend line, if the market had not made a lower low here, then we would have connected the medium-term trend line to this C. So because the market has made a lower low, we can connect the medium-term trend line to this A. Now, when the short-term trend line is broken, the market will predominantly move to the medium-term or outer trend line. Okay? And when the medium-term trend line is broken, the market will aim to test the longer-term trend line. So it's important to keep track of trend line breaks. Now, trend lines act as support and resistance. So when a uptrend line is broken, it will now act as resistance, and when a downtrend line is broken, it will now act as support. So here we have the trend line acting as resistance, as the trend line is preventing the market from going higher. So we say it's acting as resistance, and whenever it is preventing the market from going lower, in this case, we say it's acting as support. Okay? So the market breaks the inner trend line, find resistance at the backside of the inner trend line, and advances to the medium term trend line. So whenever the market breaks the inner trend line, on most occasions, it will go to the medium term trend line. And here at the medium term trend line, what did we see? We see an engulfing bullish candle. Okay? So we see an engulfing bullish candle and the market rises. So it's important to keep track of the candlestick patterns again when they occur in the direction of the trend. So we have an engulfing bullish candle here. And for example, if we buy this engulfing bullish candle at this trend line and place our stops below the trend line, we would have made a lot of money. Okay, so remember, trend lines act as support and resistance. So when a uptrend line is broken, it will now act as resistance, and when a downtrend line is broken, it will act as support. So here is an example of that. We see the market breaks the downtrend line, falls to the backside of the downtrend line, and finds support. We then see the market begin to rally. Okay, so this is an example of a downtrend line acting as support. Here is another example. We see the market breaks a trend line, falls to the backside of a trend line, and finds support here, and then also finds support here. And then we see the market begin to rally. So these are two examples of a trend line acting as support. And here is an example of a trend line acting as resistance and support. Here we have tweezer tops at the trend line. As you can see, tweezer tops at the trend line, and the market began to fall. Okay, so the market is in a downtrend. We have the trend line acting as resistance, and we also have the tweezer top candlestick pattern, and the market fell. Here we have break of downtrend line. The market falls to the backside of the trend line, finds support, and begins to rally. Okay, so always remember, trend lines can act as both resistance and support. And here we have another example. So here we see an uptrend line acting as resistance. Okay, so break of trend line, market rallies to the backside of a trend line, and we have the trend line here acting as resistance. And this is a very powerful trading technique. You can trade trend line breaks or trend line bounces. So whenever the market breaks a trend line and rallies to the backside of the trend line, you can sell the market, especially if you see a candlestick pattern. So this is an extremely powerful trading technique that you can use to trade. Now, did you learn what are trend lines and how to draw trend lines? Did you learn the significance of trend lines? Did you learn that trend lines act as levels of support and resistance? Did you learn how to trade trend line breaks and bounces? And did you learn the ABCD price wave movement and how to identify these movements? Also, if you're enjoying this course, please leave a review. Reviews are what will help keep this course relevant. So if you are enjoying this course, please leave a review. The non-farm payrolls. Now, the non-farm payrolls presents a total number of paid U.S. workers of any business, excluding workers from general government jobs, private household jobs, employees of non-profit organizations, and farm employees. Now, as this number grows, it means jobs are being created, hence more persons having jobs,
More jobs mean more people spending money, which results in economic growth. Now, the non-farm payrolls data is a very big data. It contains many things, okay? Now, as a Forex trader, we mainly focus on the headline number, which is the amount of jobs created per month. And this normally range anywhere from 100,000 to maybe 250,000. As a Forex trader, we pay attention to the headline number. That's very important because that tells us how many new jobs are created. The next thing as a Forex trader to pay attention to is the average work week and the average hourly earnings, because this will give us an idea as to whether or not the employment rate is approaching full employment. Okay? Average work week and average hourly earnings. Now the average work week is simply how many hours is worked per week. Okay? On average per person, how many hours is worked per week. That's the average work week. Okay? Now this can give us an insight into whether or not we are approaching full employment. And what full employment is simply the point at which employers will need to start increasing wages in order to attract employees. Okay? So once we reach a point where employers start to increase wages to attract employees, we call this point full employment. The central bank has to pay attention to whether or not the country is reaching full employment, because employment may start to increase inflation. Once employers starts to pay employees more, okay, once employers starts to increase wages, they will then start to increase the price of their goods and services. So the central bank has to focus on whether or not the country is approaching full employment, which is why average hourly earnings is extremely important, because as the average hourly earnings starts to increase, this will give us an idea of whether or not we are approaching full employment. Okay, so it's good to know that high employment can also cause inflation. High employment can also cause inflation, which in itself can affect economic growth. Okay, so the central bank has to pay keen attention to the non-farm payrolls data and unemployment rate so that the central bank can know when it is right to increase interest rate to prevent increased inflation caused by increased wages. Okay, so yeah, the non-farm payrolls, this is a very big data, and this can be extremely lucrative to trade. As a fundamental trader, you can make a lot of money trading the non-farm payrolls data. Once you understand this data and you understand how to use other indicators to help you to get an insight into what to expect for the non-farm payrolls data, and then you understand how to look at the non-farm payrolls data, which is to look at the headline number and to also pay attention to the average work week and average hourly earnings. And you should mainly pay attention to the average hourly earnings whenever a country is approaching full employment. So for the US, unemployment rate is currently around about 5% or about 4.9%. So the US is approaching full employment. And if the unemployment rate continues to decrease, this may affect wages, and as a result, we will see an increase in the average hourly earnings. Okay, so yeah, the non-farm payrolls indicator, this is an extremely important indicator and is watched closely by the federal bank. Gross domestic product. Now, GDP refers to the total value of all goods and services produced within a country within a given period. Now, generally speaking, GDP is a measure of production in a country. If GDP is going up, production is going up, and the country is experiencing economic growth. However, GDP is a lagging indicator and is released quarterly. Now, what do I mean by lagging indicator? A lagging indicator reflects the economy's historical performance, and changes to these are only identifiable after an economic trend or pattern has already been established. Okay, so the GDP is a lagging indicator, while leading indicators often change prior to large economic adjustments and as such can be used to predict future trends. Examples of leading indicators are retail sales, market PMI, because these change prior to large economic adjustments, while examples of lagging indicators are GDP and consumer price index, the CPI. Okay, these change after a general trend in the market. Now, rising GDP is a positive sign for an economy. And this is because rising GDP signals growth, and as the economy grows, there is increased inflation. Remember, the main tool used by central banks to control inflation is raising interest rate. So whenever there is increased inflation, this is good for a country's currency, because as a result of this, the central bank will need to increase interest rates. Okay? And central banks need to increase interest rates because rising inflation can stop the growth in GDP. And this is because if prices are rising too rapidly, the cost of goods and services may start to exceed demand. And whenever goods and services start to exceed demand, this will result in excess inventory, and excess inventory will lead to losses, which will result in producers cutting costs, which will result in loss of jobs, which will eventually result in a decrease in retail sales, which will eventually lead to decrease in GDP, and decrease in GDP will eventually lead to the central bank decrease in interest rates. So everything is connected, which is why it's important to understand how these fundamental announcements correlate, so you can see how the result of these indicators affect the central bank and interest rates. And remember, higher interest rates make money more expensive to borrow, and thereby reduce spending by those producing goods and services. Okay, lowering interest rates have the opposite effect. We will take a closer look at this when we get to interest rates. But remember the general concept: higher interest rates make money more expensive, while lower interest rates make money cheaper, and hence encourages borrowing and spending. Now, these are some of the tools used by central banks to maintain economic stability. And let's start with interest rates. Now, interest rates is the main tool used by central banks, and it's mainly used to control inflation. Okay, so if inflation is rising too rapidly, the central bank will increase interest rates. And if we have deflation, the central bank will decrease interest rates. So the central bank uses interest rates as a tool to control inflation. And it's extremely important that the central bank controls inflation because, for example, if there is growth in the economy, this will result in an increase in inflation, and inflation can stop the growth of an economy. Okay? So if an economy starts to grow, if inflation starts to rise too rapidly, this can stop the growth of an economy. This can stall the growth of an economy, which is why the Fed has to pay keen attention to inflation, and the Fed has to use interest rates to control inflation. If inflation is rising too rapidly, the Fed has to increase interest rates to control the money supply in the economy to decrease the rate of inflation. Okay? Now, price limit is also used by central banks. For example, in the past, the Swiss central bank used price limit to prevent their currency from becoming too strong. So at particular levels in the market, the central bank would enter the market selling their currency to decrease the value of their currency. Okay? So that's what we call price limit. And it can be extremely lucrative because as a fundamental trader, if you understand that there is a price limit, and if you can get into the market on the same side as a central bank, then you can make a lot of money. Now, we also have language, and this is extremely important. This is one of the tools mainly used by central banks, okay? And this is simply comments by the central banks that are aimed at affecting change in an economy. Example, hints of raising interest rates or hints of decreasing interest rates. In the past, Mario Draghi of the European Central Bank made a comment that he will do whatever it takes to save the Eurozone. And as a result, that caused extreme volatility in the euro. Okay, so these comments by members of central banks are extremely important. Let me give you an example of language. Okay, this is an example of language that can be used by a central bank. For example, let's say at their first meeting, let's say at their August meeting, for example, the head of the central bank says the economy is doing good and we don't see a need for further policy change. Let's say that's the language at the August meeting. Now let's move forward to, let's say, for example, the October meeting. Okay, now let's say if at the October meeting, the head of the central bank now says we have discussed potential policy change. However, the economy is doing good and we don't see a need for further change in policy. Now, these two statements are different, and this can really move the market because at the August statement, they never mentioned that they discussed policy change. And now at the October meeting, they disclosed that they actually discussed policy change. So that's so simple. That's how subtle language can be, and it can have a great impact on the market. Okay, so we have to pay keen attention to what the head of the central bank says. We have to pay attention to the language used by the head of the central bank. Okay, central banks can use language to affect change in an economy. Now, another tool used by central banks is quantitative easing. Now, quantitative easing is done to boost the supply of money in a country in an hope to spur growth in the economy. So they print money and they pump that money in the economy to try and spur growth in the economy. This is quantitative easing, and in doing so, they decrease the value of their currency. Okay, so whenever a central bank is engaged in quantitative easing, we can really make money trading the currency of that central bank, because quantitative easing will weaken the currency of that central bank. Now, let's say the central bank is focused on inflation. Now, if the central bank is worried that the inflation is too high, then we know that they are heading towards an interest rate increase. Hence, the currency of that central bank will increase in value. Okay? So this is the main reason why we need to focus on the central bank. We need to know the focus of the central bank at all times. Okay? That way we can tailor our trading towards the focus of the central bank. Now, central banks will focus on a maximum of two things at once. And once we know what they're focusing on, we can then figure out what tools they will use and how it will affect the market. Now, most central banks really focus on one thing, and that's maintaining price stability. However, the US Federal Bank has two mandates. Okay, that is maintaining price stability and employment. So the US Federal Bank has to focus on employment and at the same time maintain price stability. Most other central banks mainly focus on price stability. Okay, so that's the difference between the US Federal Bank and most other central banks. Now, once we understand what the central bank is focusing on, we can then try to figure out what tools they'll use and how it will affect the market. For example, if the central bank is worried about inflation, if they think inflation is rising too rapidly, they will increase interest rates. And once the central bank increases interest rates, the currency of that central bank will increase. Okay? So if we know that the central bank is focusing on or is worried about the rapid increase in inflation, then we know that the central bank is likely to increase interest rates and we can plan our trades accordingly. If we know that that central bank is going to increase interest rates, then we will be looking to buy the currency of that central bank. And the opposite goes. If they're planning to decrease interest rate, then we're looking to sell the currency of that central bank. Okay, so always focus on the central bank. Whenever we get a news report, we should ask ourselves, how will this affect the central bank's view of inflation and the economy. Okay, so focus on the central banks.
Now, there are three main ways a central bank can manipulate money supply. And this is through increasing or decreasing interest rates, increasing or decreasing the reserve requirements, and through open market operations. Now, reserve requirements is the minimum amount of cash that banks and other depository institutions are required by law to keep on hand and which may not be used for lending or investing. So in other words, the reserve requirements is the amount of money the banks need to have available to its users to facilitate withdrawals, check cashings, and other activities. Now in the US, you have two main rates. You have the Fed funds rate and the discount rate. And for the EU, there are three rates. You have the main refinancing operations rate, you have the deposit facility rate, and the marginal lending facility rate. Now, whenever reference is made to the US interest rates, this often refers to the Fed funds rate. And whenever reference is made to the European interest rates, this often refers to the main refinancing operations rate. Now, the Fed funds rate is set by the Federal Reserve as the rate that banks should charge each other for overnight loans, and the main refinancing operations rate is the rate set by the European Central Bank as the rate that banks should charge each other for overnight loans. Now, the European deposit facility rate is the rate that the European Central Bank will pay central banks that deposit their surplus funds with the European Central Bank. Now, the discount rate is the rate that the Fed charges banks when it lends the banks money. And this amount is higher than the federal funds rate, so it's used as a last resort for banks needing some cash to boost their reserves. Now, the discount rate is the same as the European marginal lending facility rate. Now, each bank has a different level of reserves at the end of the day. So banks with surplus reserves lend money to banks with insufficient reserves. And the rates that banks charge each other in the US is the Fed funds rate, and in the Euro it's the main refinancing operations rate. So banks with surplus reserves will lend money overnight to banks with insufficient reserves. And banks that aren't able to get money from other banks must borrow money from the central bank. And in the US, the central banks will charge other banks a discount rate. And in Euro, the central bank will charge other banks the Euro marginal lending facility rate. Now, open market operations refers to a monetary policy tool in which central banks buy and sell bonds to regulate the money supply in the economy. Now, when a central bank buys bonds, the money supply expands, bond sellers acquire money, banks increase their reserves, allowing them to expand the money supply through the extension of additional loans. And whenever the central bank wishes to decrease the money supply, they instead sell bonds. Okay, so a central bank can manipulate the money supply by decreasing and increasing the reserve requirements, by increasing or decreasing interest rates, and through open market operations. Now the market moves in ABCD price swing. So ABCs repeat themselves as long as the trend continues. And here we have an example. We have A, B, C, D. And then we have again A, B, C, D. Now right here you see the trend changes. Okay, so we have a different A, B, C, D. And we will also add A, B, C, D. And it would continue as long as the trend continues. Okay, so always remember we have A, B, C, D. Then we start again at C and counts A, B, C, D. So ABCs repeat themselves as long as the trend continues. Now trend lines must be drawn across the lows or highs of support and resistance, connecting A's and C's after a new high or low has been made. Now connect A's with other A's and C's just as long as you are not drawing through the candles. I'm going to show you an example of this. Here we have A, B, C, D. We connect A with C's or A's with A's just as long as we are not drawing through the candles. So when drawing an uptrend line, connect your lowest A to the C or A support that is closest to the high without drawing through the previous C or A. Okay, so we connect this A to the support or resistance. In this case, we're drawing an uptrend line, so it is support. So we connect this A to the nearest A or C without drawing through the lines. Okay, so this is an incorrect way to draw a trend line. We see the A here and we see another A here. Now you cannot draw through the candles, so you must connect this A to this A. Okay, so this is the correct way to draw the trend line. A, and the trend line is not drawn through any candle. So here we have another example of an incorrect way to draw a trend line. Now you can't draw the trend line like this, and this is because the market has not made a lower low. Okay, so the market has not made a B. You cannot connect to a A that does not have a B. This is a new A, but it has no B. There's no larger B down here, so you cannot connect to an A that has no B. So this would be the correct way to draw the trend line. Here we have A, B, C, D, a smaller A, B. Okay? And also this A cannot be connected to this A, because if you connect this A to this A, then you will be drawing through these candles here, right? So as long as the most recent A has a B, we can connect the A's to each other.
Now, fundamental correlation. And we're focusing on the PPI and the CPI. Okay, now the PPI, which is the producer price index, and the CPI, which is the consumer price index, are correlated. And as a result, a better than expected PPI data will affect market sentiments towards a better than expected CPI data. So these two fundamental announcements are correlated. And this is because the PPI, the producer price index, relates to the cost producers pay to manufacture goods and services, while the CPI relates to how much these goods and services cost consumers. So if producers are paying more to manufacture goods and services, they will in turn charge more, and consumers will have to pay more for those goods and services. So you can see how the PPI and the CPI has a direct correlation. Okay, so whenever producers have to pay more, they will charge the consumers more, and the PPI data is usually released before the CPI data, so we can use the PPI data to give us an idea of what to expect for the CPI. And this is a technique used by fundamental traders to make money trading Forex. And I'm going to show you an example of this on the economic calendar. Okay, so this is the economic calendar. This is the Forex Factory economic calendar. And we're just going to look at the correlation between PPI and CPI. Here you can see we have bad PPI data. We have PPI data coming out worse than expected. Okay, hence the red. Whenever news comes out better than expected, we have green. Whenever it comes out worse than expected, we have red. Okay, so you can see 0.7, we're getting 0.8, we're getting minus 0.2. So we have bad PPI data for this month of November. Now let's look at the CPI data, which in this case comes out the next day. We can see CPI data worse than expected. We were projecting 2.2, we got 2.1. But what's also important is the fact that previously we had 2.2 for the previous month, and now we have a decrease to 2.1. So this is bad for the CPI. Also here, we missed estimate. They were projecting 0.2 and we got 0.1. So this is bad, but this is worse because we got worse than the previous month. Now let's look at another example. Now in this case, let's see. In this case, we have better than expected PPI data. Okay? Here we can see the CPI data. Now, even though this is red, look at the previous month. Previous month was 2.1 and we got 2.1. So this is better than the one we had for November, which is the previous example I just showed, because in that example, we had a decrease from the previous month and the current month. In this case, the previous and the current is equal. So this is not as bad. Now look at this example here. Here, the previous was 1.6, the projected was 1.7, and we're bang in line with the projection. Okay? So this is good. This is okay. This is not as great, but this is okay. And this is what I mean when I say the PPI can give us an understanding of what to expect for the CPI. We got good PPI data here, so we weren't expecting a very bad CPI data. Okay? So the CPI data which we got here was okay. Previous month we had decrease in CPI. See, we have here in the previous column 2.2, and then we got a 2.1. And here, even though we have bang in line, we were less than projected. So this is an example of how we can use PPI to help us to predict CPI. And in this example, I'm using fxtrade.com economic calendar. Retail sales and GDP. Now, retail sales and GDP are correlated. So if retail sales for a specific quarter is very good, we can expect a good GDP for that quarter. So, and remember, higher GDP means better economy. So as fundamental traders, we can use the retail sales to help us to get an idea of what to expect for the GDP. Now, retail sales are released each month. Every month we have retail sales data. However, the GDP is released every 3 months, okay? Every quarter we have the GDP data. So we can use the retail sales for a specific quarter to give us an idea of what to expect for the GDP of that quarter, okay? And the reason retail sales have such a strong correlation with GDP is because for most countries, retail sales make up about 60 to 70% of the GDP. Okay, so that is the reason why retail sales have a strong correlation to GDP. If we have very good retail sales for a specific quarter, we can expect a potentially good GDP for that quarter. Now, jobless claims and unemployment rate affect the retail sales. And this is simply because if people are losing jobs, they will not have money to spend at the retail level, and hence we will have poor retail sales. Okay? If less people have jobs, then less people will have money to spend. And this will result in poor retail sales data, which will eventually lead to poor GDP. And if we have poor GDP, this would lead to the central bank moving towards decreasing interest rate or even quantitative easing. Okay, so high unemployment will lead to poor retail sales, which will eventually lead to poor GDP, which will eventually lead to the central bank decreasing interest rate. And remember, whenever a central bank decreases interest rates, this will cause the currency of that central bank to decrease in value. Okay? Now, housing data and durable goods are correlated. And this is simply because more people buying new houses will result in more people buying new appliances. Okay, if we have better than expected housing sales, this should result in good durable goods data. So this is something you can use as a fundamental trader to trade the durable goods data. You can pay attention to the housing sales and then use the housing data to trade the durable goods data. And I'm going to go to fxstreet.com to take a closer look at the correlation between housing data and durable goods. Okay, so here we can see we have better than expected housing data. Existing home sales are better than expected. Here we have the previous month's data, what analysts are projecting, and the actual data. So this is the previous data. In this column, we have what analysts are projecting, and here we have the actual data. So you can say that the actual data is better than what analysts were projecting, and it's better than the previous month. So this is very good data for existing home sales. And remember, housing data is released before the durable goods data. Hence, we can use the housing data to trade the durable goods data. Now let's take a look at the durable goods data. Okay, so here we can say for durable goods, it's better than expected. Okay, it's better than expected data. Very good durable goods, and we would have been expecting this based on the housing data. Okay, so this is how we can use fundamental correlation to make money trading Forex. Now, in Forex, there are several different types of orders. We have the instant order, which is the same as the market order, and this is instantly executed at the current price. This is the order that you make when you enter a trade. It's an instant order, and it takes you into the market instantly. We also have a pending order, and this is executed at your target price. Okay, so for example, you think the market's going to come to a particular price, then you set your pending order at that price, and whenever the market reaches that price, you're entered in the trade. We also have stop loss orders, which are executed at your target price to prevent loss. We also have take profit orders, which are executed at your target price to lock in profits. Now, when you place an order, you must also place a stop loss order and a take profit order. And remember, when you buy, you must exit by selling. And when you sell, you must exit by buying. Now, this is automatically done for you. Once you enter the market by buying, whenever you choose to exit, you automatically sell. And whenever you sell, whenever you choose to exit, you automatically buy. So this is automatically done for you. Stop loss orders and take profit orders can be either sell orders or buy orders. It depends on your initial order. Okay, so if your initial order was a buy order, then your stop loss order will be a sell order. Now, this is an example of why it's important to let your profits run. Okay, it's important to keep your risk small and let your profits run. That's how you make huge amounts of money in Forex. You keep your risk small and you let your profits run. Okay, so you set a take profit to take some profit off the table, and then you let the rest of your profits run, because you never know when you're going to get a big winner. And this is an example. Here the market has fallen over 300 pips, and we have a stop loss order here. We have a
instant execution, which is also called a market order here. And we have the take profit order, which takes you out of the market with a profit.
Now, in this lecture, we're going to focus on non-farm payrolls, and I'm going to show you an example of the non-farm payrolls and unemployment rate data on some charts. Now, you can remember from the previous lecture, the PMI data can be used to help to predict the non-farm payrolls data. The non-farm payrolls data is an extremely important data. It is a data that can make you a lot of money, okay? So it is extremely important as a Forex trader that you understand how to gain an understanding of what to expect for the non-farm payrolls data. So you can use the PMI data and you can pay attention to the employment component of the PMI, which will give you an indication of what the non-farm payrolls will be like. You can also use the ADP report, which will tell you what the private job sector is like. So if this number is good, let's say above 160K, then we can expect a good non-farm payrolls data. We can also use the unemployment claims. And this is a data that is released every week. Every week we have unemployment claims. And we can keep track of the unemployment claims each week to get an idea of what to expect for the unemployment rate and what to expect for the non-farm payrolls. And all these indicators, you can find out more about all these indicators on fxstreet.com and also on forexfactory.com. Also, you can do a Google search of these indicators and you can get more information on these economic indicators. Now, we also have the Challenger Job Cut Report. This will also give you an idea of what to expect for the unemployment rate. And we can also use personal spending. And this is because good personal spending data also indicates good employment, as more personal spending indicates higher employment, hence more consumers in the market spending. Okay, because if more people are employed, then there are more persons in the marketplace to spend on goods and services. So good personal spending will generally indicate good employment. Okay, so we can use all these indicators to give us an understanding of what to expect for non-farm payrolls and the unemployment rate. Now let's look at some examples of the effect of non-farm payrolls and unemployment rate on the market. Now here we can see we have a non-farm payrolls data that was worse than expected. Okay, we got 215,000 when analysts were projecting 223,000. And this is very bad because the previous was 231,000. So this is bad for the US dollar. And this chart here, this chart you're looking at here is the Euro USD. So if the data is bad for the US dollar, we can expect the Euro USD to rise value. Okay, and as you can see, for the employment rate, the data is the same. It's just as expected. So no surprise here. The market was expecting this. Now for the unemployment rate, the data is exactly as expected. Okay, it's not better than expected. It's not worse than expected. It's as exactly as expected. So this will not really have a great impact on the market. Okay, because this was expected. What should have an impact on the market is the poor non-farm payrolls data. Now, again, this is the Euro USD, so bad US data should result in the Euro USD rising. Now, here is the exact time when the non-farm payrolls data was released. Okay, here is the exact time when the non-farm payrolls data and unemployment data was released. So initially the market fell. However, the market then stopped and rallied. Initially the Euro USD fell, which means the USD rised in value initially. However, the market then stopped and rallied. And the rally is expected because this data is bad for the US dollar. So the US dollar should decrease in value and the Euro USD currency pair should rally. Whenever the US dollar decreases in value, the Euro USD currency pair rises, and whenever the US dollar increases in value, the Euro USD currency pair falls. Okay, so this was as expected. The market fell and then eventually rallied because of the poor non-farm payrolls data release coming out of the US. So the US dollar decreased in value. Now, this is a lovely example. Here we can see we have poor non-farm payrolls data. However, we have good unemployment data. Okay, so there's a conflict here. One is bad, one is good. So in cases like this, the market will eventually move in the direction of the stronger economic indicator. And the unemployment rate is a stronger economic indicator than the non-farm payrolls. So if the unemployment rate data is good for the US, in this case, we're looking at the Euro USD currency pair. If the unemployment data is good for the US, we should expect an increase in the value for the US currency, which should result in a fall in the Euro USD currency pair, which is exactly what we see here. So we got the news here. The non-farm payrolls and unemployment rate was released here at this specific time. Market rallied, then went sideways, and then eventually fell because we had better than expected employment data. So in cases like this, the stronger economic indicator will determine the direction of the market. Risk appetite. Now, this is when the economy is doing good and persons are willing to take risk. Okay? So if we have a stream of good economic data, this may cause risk appetite in the market. Now, risk aversion is when the economy is not doing so well, and as a result, persons are not willing to take as much risk. And we can have risk aversion after a series of bad economic data. Okay? So if we have a series of good economic data coming out of the US, this may cause risk appetite. And if we have a series of bad economic data coming out of the US, this may cause risk aversion. Also, other things like geopolitical news and other stuff can cause risk aversion and risk appetite. Now, when there is risk appetite, some traders will tend to invest in currencies with higher interest rates. For example, the Australian dollar. And this is because their central bank pays more interest. Okay? So whenever there is risk appetite, we will have a rise in certain currencies. For example, whenever we have risk appetite, we can expect to see a rise in the Japanese dollar. Okay, and we will discuss this further on in the course. So, for example, you might see very good news coming out of the US, and as a result, the Australian dollar rises. And this is simply because whenever we have risk appetite in the market, traders are more willing to risk, investors are more willing to risk, and as a result, they may invest in currencies with higher interest rates. Okay, so that's risk appetite and that's risk aversion. These are two important tools that you can use to help you whenever you're trading Forex. Now, section recap. Now, whenever you're trading fundamental analysis, you should always understand the cause or the potential cause of the move using the news sources. Okay? Always try to identify the cause of the move. The next thing is you can use correlation to help you to decipher the potential outcome of a fundamental announcement. Okay, remember we can use the retail sales to give us an idea of what to expect for the GDP, and we can use the ADP report, and we can use the employment aspect of the PMI to give us an idea of what to expect for the non-farm payrolls. Okay, so fundamental correlation is something that you can use to make money trading Forex. Now remember, moves caused by change in market sentiments are temporary, and once the fundamental picture is the same, the market should continue in the same direction. The market should continue in the direction of the fundamentals. If the fundamental picture is bullish, the market should rise. So move caused by sentiment are temporary. And always remember that anticipation is key. The market is mainly speculative, so understand what the market is anticipating and you will make money trading Forex. By the end of this section, you will understand what are the 5 major US fundamental indicators. You will understand how GDP affects a country's currency. You will understand the importance of balance of trade in Forex. And you will learn about the importance of the Philly Fed Index. Now, here are the 5 major US fundamental indicators. We have gross domestic product, non-farm payrolls, balance of trade, Treasury International Capital Survey, otherwise called TICS, and we have the Philly Fed Survey, also called the Philly Fed Index. Now, each of these indicators gives us insight into the state of the US economy. When they are combined, they give us an overall view of the US economy and as a result, help us to identify the future direction of the US dollar. And remember, the primary driver of market sentiment is interest rate. So all the economic data that is disclosed is used as an indicator to assess the likelihood of the central bank raising or lowering interest rates. Okay? So always remember, the primary driver of market sentiment is interest rate. How likely is the central bank to raise or decrease interest rate? If we have good GDP, good non-farm payrolls, and economy is going good, then we can expect the central bank to increase interest rate. And whenever the central bank increases interest rate, the currency of that central bank will rise. And this is simply because investors will invest in a country that is increasing interest rate because they will get more return on their investments. Okay? It's simply because of the transfer of money from countries that are decreasing interest rate to a country that is increasing interest rate. So that's the main reason why whenever a central bank increases its interest rate, the currency of that central bank increases in value. So always remember that interest rates are the primary driver of market sentiment. Major economic indicators. Now, these are the categories for the major economic indicators. The central banks use these indicators to get an overall picture of how bad or how good the economy is doing. Okay, now let's take a look at these indicators. First, we have production, and this refers to anything that the country makes. Through these indicators, the central bank can see whether the country is being productive or not. And examples of production indicators are PMI, the Philly Fed Index, etc. These indicators are used by the central banks to gain an understanding of how well the country is producing. This will give the central bank an idea of the level of production in a country. Okay, and this contributes to the overall view that the central bank has of the economy. Now we have geopolitical indicators, and these are also important. These are non-economic things that can cause risk in the market. For example, change in government, wars. Okay, these are things that are non-economical that can cause risk in the market. Okay, so the central banks has to pay attention to geopolitical news. Now, employment. Now, this refers to how many persons are employed or unemployed. The indicators that fall under this category measure the level of employment in a country. And examples of employment indicators are the non-farm payrolls, and we will discuss this further on in the course. we have the non-farm payrolls, and we have jobless claims. Okay, these are two examples of employment indicators. And the federal bank and all central banks pay attention to employment data so they can gain an overall perspective of the economy. Okay? Now, we also have growth indicators. And an example of a growth indicator is GDP, gross domestic product. And these measure growth in a country. Okay, is the country growing? Is there an overall increase in production, or is there a decrease in production? And we also have inflation. And an example of an economic indicator that falls under the category of inflation is CPI. And that is a consumer price index. And this simply measures how the cost of goods and services are moving. And this is extremely important because inflation is the main mandate of most central banks. Okay, so this indicator is extremely important, and as a forex trader, it can be extremely lucrative trading the CPI economic indicator. Now, by the end of this section, you will understand what to focus on when trading fundamental analysis. You will understand the importance of fundamental announcements and how they can make you money. You will learn about some of the various news sources in Forex. You will learn the main tools used by central banks to maintain economic stability, and you will learn the main types of economic indicators. Now, every country has a central bank that manages the monetary policy of that country. Now, the function of the central bank is to maintain economic stability, and the central bank does this by monitoring various economic indicators to get an idea of how the country is performing. Now, the central bank then, based on the state of the economy, implements various changes in monetary policy, such as raising or decreasing interest rates. Now, fundamental announcements, economic indicators, risk events, these are just different terms used to describe the same thing. Okay? Now, every month there are several fundamental announcements, and some have a huge impact on the market and can cause major movements in prices, while others have a small effect on the market and will not affect much price movement. For example, balance of trade doesn't normally have a huge impact on the market. That fundamental announcement may cause the market to move maybe, say, 40 to 60 pips. Okay, balance of trade doesn't normally have a huge impact on the market. However, non-farm payrolls, NFP, has a huge impact on the market. Okay, this is the US non-farm payrolls, and this is released on the first Friday of every month, and this usually has a huge impact on the market, and prices can rally anywhere from 100 to over 200 pips. Okay, so the non-farm payroll announcement can be extremely volatile, and at the same time it can be extremely lucrative. Okay, once you understand how to trade it and you manage your risk, it can be very lucrative. Now, CPI, okay, now this can really move the market. Okay, depends on if the result is as expected, then it may not have such a huge impact on the market. But if we get a result that is better than expected, we can see the market moving, say, 150 pips. So the CPI is based on the result. Now, retail sales also can move the market, and on average, as you can see, normal retail sales may move the market, say, 60 to 100 pips. And again, it's all based on the result. A result that is better than expected will result in a more volatile move, okay? Especially a result that is way better than expected. Okay, if we get a result that is way better than expected or way worse than expected, we can expect some market volatility. Okay, so each fundamental announcement affect the market differently. Now, each country has their own fundamental announcements, and each country's fundamental announcements are released at different times, okay? We will mainly get fundamental announcements for the US at around 8:30 Eastern to around 10 o'clock Eastern. And for, let's say, the UK, we may get fundamental announcements at around 2 a.m. Eastern to about 4:30 Eastern. Okay, so you can use this table to give you an idea of when to expect fundamental announcements from various countries. Also, you can use the economic calendar, which gives you the time and the date for each fundamental announcement. Okay, so further on in the course, we will talk about the economic calendar, which you can use to give you the time and the date for each fundamental announcement. Balance of trade. Now, a country's balance of trade is the economic value of all the products that it exports minus the economic value of all the products it imports. Now, a positive balance of trade is when a country exports more than it imports, and a negative balance of trade is when a country exports less than it imports. Now, a negative balance of trade indicates that more money is being taken out of the economy, which means less money is available for investments that increase productivity. So a negative balance of trade is negative for a country's currency, okay? And it's negative for the overall economy. Now, every month, the US balance of trade operates at a deficit of approximately negative $44 billion. Now, this is very bad for the US. However, because of the US stock market and because of the overall investment environment that the US provides, the investment environment that the US provides kind of offset the effect of this negative balance of trade. But the negative balance of trade is still bad for a country's currency. So when the deficit decreases from month to month, that is positive for the US dollar, as that means less money is leaving the economy. So we can pay attention to the balance of trade to get an idea of how much money is leaving the US economy. And if we can see a trend in which the deficit is increasing from month to month, this is overall negative for the US and it's negative for the US currency. Okay, if we can see a trend in which the deficit is decreasing from month to month, then this is positive for the US and is positive for the US dollar. Treasury International Capital Survey, otherwise called TICS. Now, TICS is a measure of foreign investment back into the US economy. Okay? Now, the TICS measures the amount of US Treasury debt, bonds, bills, and notes sold to foreign investors. Okay, not US investors, foreign investors. Okay, the TICS measures the amount of these sold to foreign investors. So if more foreign investors are buying US debt, that means more money is entering the US economy. Because, for example, let's say you are a Japanese investor. Now, if you are a Japanese investor wishing to buy US bonds, you will first need to buy US dollars. Okay, so you will need to use your yen to buy US dollars and then use those US dollars to buy US bonds. And in buying US dollar, you are increasing the value of the US dollar because you're increasing the demand for the US dollar. So if each month TICS covers the monthly trade deficit, we have a balance. Remember, the US operates at a trade deficit of approximately negative $44 billion. Okay? So the US operates at a trade deficit. Now, if each month TICS, which measures the amount of US debt sold to foreign investors, if each month TICS covers the monthly trade deficit, then we have a balance, and this is positive for the US dollar. And if TIX exceeds the monthly trade deficit, this is even more positive for the US dollar. Also, if TIX fails to cover the monthly trade deficit, this is bearish for the US dollar. So remember, TIX measures the amount of US debt sold to foreign investors. So TIX gives us an idea of how much foreign money is entering the US economy. Okay, so that is it for Treasury International Capital Survey, also called TIX. The Philly Fed Index. Now, the Philly Fed Index is a measure of manufacturing expectations, and this survey is conducted by the Philadelphia branch of the Federal Reserve. Now, every month, top manufacturers are surveyed for their expectations and current conditions, and this data is then used to develop a numerical index called the Philly Fed Index. And a positive or rising value for this index, that is a value above zero, is seen as positive for the economy, as more manufacturing equals more growth. So whenever we have a Philly Fed Index value above zero, this is seen as positive for the manufacturing sector. Okay, and whenever we have a Philly Fed value below zero, this is seen as negative for the manufacturing sector. Okay, so the Philly Fed Index is an important indicator that can be used to give you insight into whether the US manufacturing sector is doing poorly or whether the US manufacturing sector is doing good. So we can use the Philly Fed Index to give us a good idea of what to expect for the PMI, the Purchasing Managers Index. That is one way you can use the Philly Fed Index. You can use the Philly Fed Index to give you an idea of what to expect for the PMI. And the Philly Fed Manufacturing Index is released before the PMI, before the Purchasing Managers Index, okay? You can use the Philly Fed Manufacturing Index to give you a good idea of what to expect for the PMI. So remember, the Philly Fed Manufacturing Index, this is a very important indicator because it gives you an idea of how well the US manufacturing sector is doing. Okay, and remember, more manufacturing equals more growth. More growth equals rising inflation, and rising inflation equals higher interest rates. And whenever a country increases its interest rate, the value of that country's currency increases. The Philly Fed Manufacturing Index, also called the Philly Fed Survey. Interest rates. Now remember, the market is focused on whether or not the central bank is likely to move interest rates and in which direction. Now, if together the economic data suggests growth, then it is more likely that the central bank will raise interest rates to control the inflation caused by the growth, as rising inflation will negatively affect growth. Now, economic growth can cause increased inflation, and this is simply because more production, more persons employed, more persons working will eventually lead to an increase in demand in the market, because more persons having money, more persons willing to spend. This increase in demand for goods and services may lead to increase in prices. Okay, if producers, manufacturers and producers cannot supply the goods and services to meet the demand, they will in turn increase the price of those goods and services. Okay, and this will cause inflation, which will negatively affect economic growth. Okay, rapid inflation will negatively affect economic growth. So the central bank tries to obtain gradual inflation, not rapid inflation, but gradual inflation, sustained gradual inflation at a certain pace. Rapid inflation will affect negatively economic growth, because if prices start to rise too rapidly, this may result in a decrease in purchasing power. Demand for goods and services will decrease because less persons will be willing to pay the higher price for the goods and services. Okay, and remember, if there is a decrease in demand, this will result in a decrease in production, which will eventually lead to producers cutting jobs. Okay, and less jobs will eventually lead to decreased spending, which will eventually lead to the central bank having to decrease interest rates to try to stimulate the economy to boost back spending. So rising growth can cause increase in inflation, which may negatively affect the economic growth. So the central bank has to pay keen attention to inflation. Now, remember, if the central bank decreases interest rates, this will make money cheaper to borrow. Okay, and if money is cheaper to borrow, more persons will be willing to borrow money, and hence more investing in the economy, more persons borrowing money because money is cheaper. More investing in the economy results in more spending. More spending means greater money supply in the economy. Now, if the central bank increases interest rates, this means money is more expensive, less persons are likely to borrow money from the banks, hence less investments in the economy and less spending because the money supply has now decreased because less persons are willing to borrow money from the bank. Hence, this will cause a decrease in the money supply in the economy, which should prevent prices from rising too rapidly. Okay, if the money supply decreases, less persons have money, which means less demand for goods and services, which should slow down or prevent prices from rising further. So the central bank has to increase interest rate to prevent rapid rise in inflation, and the central bank has to decrease interest rate to try to stimulate demand in the economy. Okay, to try to stimulate inflation in the economy, the central bank has to decrease interest rate. And there are many other ways that the central bank may try to stimulate demand in the economy or try to stimulate inflation. The central bank may use quantitative easing and other means to try to stimulate demand in the economy and try to stimulate inflation. Okay, now section recap. Focus on how likely the news release will be in affecting the current sentiment towards interest rates. Okay, remember the focus is always on interest rates. Now remember, the higher the interest rate, the more attractive it is to investors who are looking to gain interest on their capital. As a result, whenever a country raises interest rates, we tend to see an increase in demand for that country's currency. Okay, so remember, whenever a country starts to increase interest rates, investors will look to invest in that country in order to gain from the increase in interest rate. Okay, so that is it for interest rates and this section.
Now, the most influential central bank of all is the Federal Reserve Bank. And the monetary policy making body of the Federal Reserve is called the FOMC. And this stands for Federal Open Market Committee. The FOMC consists of 12 members. We have the 7 members of the Board of Governors and 5 of the 12 Reserve Bank presidents. Now, the mandate for the Federal Reserve is long-term price stability and sustainable growth. So the Federal Reserve aims to keep inflation right around that 2% level. Now, as it pertains to meetings, the Fed meets 8 times for the year to discuss monetary policy. Now, the monetary policy making body of the ECB is the Governing Council. Now, the Governing Council consists of the 6 members of the Executive Board plus the governors of the national central banks of the 19 euro area countries. Now, the mandate for the ECB is long-term price stability. The ECB aims at maintaining inflation rates below but close to 2%. And as it pertains to meetings, the ECB meets every month to discuss monetary policy. Now, for the Bank of England, the monetary policy making body is the Monetary Policy Committee, also called the MPC. And this consists of 9 members, including a governor, 2 deputy governors, 2 executive directors, and 4 other members. Now, the mandate for the BOE is long-term price stability, keeping inflation around the 2% mark, and sustainable growth. Now, it's extremely important because if inflation falls below 1% or rises above 3%, the governor of the Bank of England has to write a letter to the Chancellor explaining the reason why inflation is so far from the target. So, the governor has to write a detailed letter explaining the reasons for this deviation, and later on in the course you will get a copy of one of these letters. Now, as it pertains to meetings, the MPC meets monthly for a 2-day meeting, usually on the Wednesday and Thursday after the first Monday of each month. Now, for the Bank of Japan, the monetary policy making body is the Monetary Policy Committee, and it consists of the governor, 2 deputy governors, and 6 other members. Now, the mandate for the Bank of Japan is long-term price stability with inflation at top focus. As just as the Eurozone, Japan is also an export-based economy, so the central bank always aims to keep the currency from becoming too strong. Now, as it pertains to meetings, the MPC meets once or twice a month. Now, for Switzerland, the monetary policy making body of the SNB is the governing board, and this consists of 3 members, the chairman, vice chairman, and an additional member. The SNB's mandate is maintaining price stability. This is maintaining inflation right around the 2% mark. Switzerland is also an export-based economy, so their central bank also aims to keep their currency from becoming too strong. And on several occasions in the past, we have seen the SNB literally intervene in the market, selling their currency to weaken their currency. Now, for meetings, the SNB meets every 3 months. Now, for Canada, the monetary policy making body is the Governing Council, and this consists of a governor, the senior deputy governor, and 4 deputy governors. The mandate for the Bank of Canada is keeping inflation low and stable, that is between 1 and 3%. The Bank of Canada meets around 8 times per year to discuss monetary policy. Now, for the Reserve Bank of Australia, the monetary policy making body is the RBA board, and this consists of the RBA governor, the deputy governor, the secretary to the treasury, and 6 independent members. Now, the mandate for the RBA is to maintain price stability with inflation around 2 to 3% and maintaining economic prosperity. And for meetings, the RBA meets 11 times for the year. Now, for the Reserve Bank of New Zealand, the monetary policy decisions are made by the governor. And the mandate for the Reserve Bank of New Zealand is to maintain price stability, that is inflation around 1 to 3%, and to avoid instability in interest rates and exchange rates. The Reserve Bank of New Zealand also meets 8 times for the year. Now, it's extremely important to pay attention to the CPI data and other inflationary reports, and this is because the central banks are paying keen attention to these data in order to carry out their mandate, which is to maintain price stability. This is why the CPI data, which is the Consumer Price Index, is so extremely important. Also, you may hear the terms dovish and hawkish. Dovish simply means that the central bank is more leaning towards decreasing interest rates or keeping interest rates at the same level, while hawkish means the central bank is leaning towards increasing interest rates or tightening monetary policy. So dovish means the central bank is leaning towards decreasing interest rates or loosening monetary policy, while hawkish means the central banks is leaning towards increasing interest rates or tightening monetary policy. So it's extremely important as a fundamental trader that you understand these central banks, you understand their mandates, and you have a good idea of when they're going to meet to discuss monetary policy. So go over these lectures again and ensure that you understand each central bank's mandate and their inflation target. Now, these are the top importers of oil. We have China, then the United States, then Japan, and then we have India. So, in order to understand the long-term reason why oil prices are falling, you must understand that until September 2013, the United States was the largest importer of oil. Now, although the United States is still the largest consumer of oil, they have now started producing more oil internally, which has resulted in a decreased demand for foreign oil. So countries like OPEC member countries and other oil producing countries that used to export oil to the US now have to be competing for other markets. And because of this, they have to decrease their prices, resulting in lower oil prices. So if US decreases their oil production and start importing more oil, then this may result in a long-term increase in the price of oil. So it's important to be aware of whether or not the top importers have decided to decrease their importation of oil. Now here's a list of some of the factors that are contributing to the long-term sell-off in oil prices. We have a rise in supply as US production has picked up with the advent of shale gas investments on a large scale. We have the fact that OPEC at their last meeting had not agreed upon a production ceiling. We have the fact that the economies of Europe and other developing countries are weak and vehicles are becoming more energy efficient, hence less demand for oil. Also, a decrease in demand in China. So China has also decreased their imports of oil. And this is just because of a general slowdown in China. So these are some of the things that have been causing the long-term sell-off in oil prices. Now here's a list of other factors that affect oil. If an oil-rich area becomes politically unstable, supply markets react by bidding up the price of oil so that supplies are still available to the highest bidder. Also, clients purchase futures to hedge against oil price increases that could adversely affect their profitability. So, oil futures also affect the price of oil. Extreme weather conditions, for example, hurricanes, tornadoes, can physically affect production infrastructure, disrupting the supply of oil and induce price spikes. So natural disasters also affect the price of oil. Oil is traded and sold internationally in US dollars. So dollar depreciation generally tends to increase oil demand and raise the price of oil. So if US dollar is falling, this may result in a increase in oil prices. Also, seasonal changes. In the winter, more heating oil is consumed, and in the summer, people drive more and use more gasoline. So in winter and summer, oil prices tend to rise. So there are a lot of factors that affect oil prices, and it's important to be aware of all these factors. Now, some currency pairs are strongly correlated to each other. We have the Euro USD, which shares a negative correlation with the USD Swiss, which means if the Euro USD is rising, you will have the USD Swiss falling. And the Australian USD shares a positive correlation with the New Zealand USD, which means whenever the Australian USD is rising, so is the New Zealand USD. Now, you can use this chart to help you to increase your profit when trading correlation. And an example of how you can do this is whenever you observe the Euro USD rising and the USD JPY rising, the best trade would be to buy the Euro JPY. Another example of this is whenever you see the Euro USD rising and the Aussie USD falling, then the best trade would be to buy the Euro Aussie. The Canadian dollar. Now, Canada's exports account for a third of Canada's GDP, and 85% of Canada's exports go to the US. So this means that the state of the US economy greatly affects the state of Canada's economy. Now, Canada operates with a budget surplus and a trade surplus. This means that the Canadian government earns more than they spend, and Canada exports more than they import. So Canada operates with a budget surplus and a trade surplus. Now, Canada is the world's 14th largest producer of oil, and this is the main reason why the Canadian dollar is positively correlated with oil. Whenever oil prices rise, so does the Canadian dollar. And this is because of how much oil Canada exports. So as a fundamental trader, whenever you are aware that oil prices will rise, you should buy the Canadian dollar, and whenever you are aware that oil prices would fall, you should sell the Canadian dollar. Now, Japan has very little energy production, which means Japan imports most of the oil it uses. Japan is also an export-based economy, and as a result, the Bank of Japan actively aims to keep the currency from becoming too strong. Now, the Japanese yen has a negative correlation with the price of oil, and this is because Japan produces very little oil and imports almost all the oil it uses. So whenever oil prices rise, the Japanese yen falls. Now, Japan is also a safe haven currency due to the fact that Japan is the world's largest creditor. So in times of turmoil and political instability, the Japanese yen rises. The Swiss franc. Now, the Swiss franc is also a safe haven currency, and this is due to their political neutrality. So this means the Swiss franc will rise in times of political instability. Also, Switzerland is an export-based economy, and as a result, the Switzerland National Bank actively aims to keep the currency from becoming too strong. A large amount of the world's wealth management takes place in Switzerland, and more than 25% of Switzerland's money is backed by gold. So this means that whenever gold prices rise, so does the Swiss franc. Now, the Australian dollar and the New Zealand dollar. Now, exportation of agricultural products contribute greatly to the GDP of Australia and New Zealand. These currencies are commodity currencies. They share positive correlation with commodities. So whenever the price of commodities rise, these currencies also rise. Now, Australian dollar has a strong positive correlation with gold, and this is because Australia is the third largest producer of gold. Now, both currencies are very sensitive to Chinese data, and this is because of the close trade relationship between these countries and China. So if we have bad fundamental data coming out of China, we can expect the Australian dollar and the New Zealand dollar to fall. So if you're trading the Australian dollar and the New Zealand dollar, You need to also pay keen attention to Chinese data. Also, dairy products greatly affect the New Zealand dollar, and this is because New Zealand export a lot of dairy products. So whenever the price of dairy products fall, so does the New Zealand dollar. Now, the price of oil and inflation are positively correlated. As oil prices move up or down, inflation follows in the same direction. And this is because oil is a major input in the economy. It is used in critical activities such as fueling transportation and heating homes. So if input costs rise, so should the cost of end products. And an example of this is plastic. Oil is used in the manufacture of plastic, so whenever oil prices rise, so does the price of things that are made with plastic. Now, the current oil route is now worse than any since 1970, with the price of oil falling from $115 a barrel in the summer of 2014 to an 11-year low below $32 a barrel, and is now at about $29 a barrel. If oil continues to fall, this may have an harmful effect on the global economy, and this is because falling oil prices result in deflation, and deflation can have a detrimental effect on an economy. This is because if persons are expecting prices to fall at a later date, then they will put off spending, and this will result in a decrease in demand. And if there's a decrease in demand, then this will result in a decrease in production, and a decrease in production will eventually lead to unemployment. So deflation can be extremely detrimental to an economy. Now, what happens in one country can create turmoil in other countries. Say, for example, Australia is going through an economic slowdown. This may result in an economic slowdown in the New Zealand economy, and this is because of the close trade relationship between the two countries. So, as a result, if the Australian economy is doing poorly, this may negatively impact the New Zealand economy. So this is why whenever the Aussie USD currency pair rises, so does the New Zealand USD currency pair. Now, in the next lecture, we'll be looking at why have oil prices fallen. OPEC is an intergovernmental organization of oil exporting developing nations which aims to ensure oil prices remain stable within the global oil market. Now, OPEC has 12 member countries, which include Algeria, Angola, Nigeria, Saudi Arabia, United Arab Emirates, among many others. Now, while OPEC countries produce about 40% of the world's oil, they hold 80% of proven global oil reserves, and 85% of these reserves are in the Middle East. So, whenever OPEC decides to decrease production, oil prices increase, and whenever they allow production to increase, oil prices fall. Now, non-OPEC suppliers produce 60% of the world's oil, and although they are 50% larger than OPEC, they don't have sufficient reserve to be able to control prices and can only respond to market fluctuation, which is why we only really pay attention to whether or not OPEC increases or decreases their oil production. This is because the other oil suppliers don't possess enough oil reserve to exert the same influence that OPEC has on the price of oil. twice a year or more frequently if required, the oil and energy ministers of the OPEC members meet to decide on the organization's output level. And it is extremely important that you are aware of these meetings, because following these meetings, the price of oil may rise or fall rapidly. And I'm just going to show you an example of this. Now, here is a chart of oil prices, and these vertical lines represent OPEC meetings. And as you can see, the price of oil fell rapidly after each meeting. We see the meeting in July here, and the reason for this is OPEC refused to decrease their oil production. And as a result, oil prices continue to fall. And this is because if OPEC decreases their oil production, this would result in a decrease in the supply of oil. And without a decrease in demand, would result in an increase in oil prices. So, as a fundamental trader, you should always be aware of OPEC meetings, because as you can see, trading the result of OPEC meetings can be extremely lucrative. Here we can see if you sold the market after this meeting, you would have made a lot of money, and if you sold the market after this meeting, you would have made a lot of money. So as a fundamental trader, it's extremely important that you pay attention to OPEC, because you can make a lot of money trading the result of each meeting. So here are some steps to fundamental trading. So the first thing you should do is start by getting an overview of the market. Okay, and you can do this by visiting news sites such as fxstreet.com, Forex Factory, DailyFX, Forex Live, Bloomberg Currencies, centralbank.com, etc. Okay, those are news sites that you can visit to get an overview of the market. So the first thing you should do is get an overview of the market. Then the next thing you should do is identify the main cause of yesterday's price move and the main cause of yesterday's sentiment. So you have to identify the reason why the market was moving yesterday and what caused the sentiment. The next thing you should do is identify the cause of the market sentiment for the most recent session. Okay, so if we're in New York session now, you want to identify the cause of the market sentiment for the London session. So that's very important. What was driving sentiment for the previous session? Okay, so the next step is to identify what is causing the sentiment for the current session. Okay, so you have to ask yourself, what is the market doing now? If the market is rising, then you have to ask yourself, why is the market rising? And then you can visit the news sites to find out what is causing the current market sentiment. You have to also ask yourself, has anything happened to impact the sentiment? For example, has any fundamental announcement come out worse than expected? Okay, was it significant? For example, if we were expecting CPI to come out at 1.7 and it came out at 1.2, that is a significant deviation, and that can really drive market sentiment. Okay, so you have to ask yourself this: has any fundamental announcement come out worse than expected or better than expected? If there's news driving the market, you have to always ask yourself, how is this news compared to the overall fundamental outlook of the currency? For example, if we're trading the Australian dollar and the overall outlook for the currency is bearish because, say for instance, they have had talks about decreasing interest rates, which means the overall fundamental outlook for the currency is bearish, and then we get bad CPI data, then this agrees with the overall fundamental outlook, and this would be an excellent opportunity to sell the Australian dollar. So whenever fundamental announcements come out in line with the overall fundamental outlook for a currency, that's an excellent trading opportunity. So if the fundamental outlook for a currency is bullish and then we get good fundamental announcement for that currency, then that's a good opportunity to buy that currency. once it has reached a good price level. Okay. Now, the next thing is, are there any upcoming fundamental announcements? As a fundamental trader, you have to always be aware of what's happening on the economic calendar. Okay. So you have to pay keen attention to the economic calendar, and you can use FX Street calendar, or you can use Forex Factory economic calendar. So you have to always ask yourself, are there any upcoming fundamental announcements? And is the news strong enough to cause increased market volatility? Say, for example, you're going to place a trade on a fundamental announcement. You have to first ask yourself, is this fundamental announcement significant enough to cause increased market volatility? Okay.